market has unfortunately undone a lot of the hard work that the Fed had been doing over previous months.
The market thinks basically in a year's time, inflation is going to be back at 2.5%.
We still think that the Fed has more to go and then also will ease policy less next year.
I do have confidence the Fed will eventually do what's necessary and that we'll ultimately get back to something close to 2%.
The real divergence comes in 2023, where the market is pricing rate cuts and the Fed is expecting to continue to hike.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Is Harry Kane in one direction? Matt Miller is killing me this morning. Live from New York City. Good morning for our audience worldwide. This is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro, together with the brilliant Katie Lyons. Bramo back with us on Monday. TK, if you wanted a quiet end to the week, you're not getting it. On the S&P, we're down 0.8%. On the Nasdaq 100, we're down 1 full percentage point.
Forget about the float of the summer weekend, John. I'm wearing tweed today. I broke out the tweed, John, because I just saw the first leaves in Central Park beginning to change yesterday. And this is the beginning of autumn, and you saw it yesterday afternoon with the real collapse of the currency market. It continues this morning. We can go through it, John. To me, the emerging market, the United Kingdom, is a litmus paper this morning for the stress within the European system.
You want to wind people up this morning, don't you? EM, the UK. Autumn started on August 19th. TK called me yesterday, Kaylee, to tell me that the leaves are changing colour in Central Park. I'm going to park all of that. Tom, this from Barclays a little bit earlier this morning. Stocks may face a reality check next week. That Chairman Powell's speech confirmed for next Friday, 10 a.m. Eastern Time.
I looked very carefully, John. I use the Dow Jones Industrial Average for this because it's just a bigger and a more clumsy proxy than SPX. And the answer is the Dow, even with the 3 days of stress, sits between a solid moving average and 2 standard deviations up. So we're really technically not at a stress point yet for those markets. But I take the point, a week from now, you could be there.
Kaylee's going to straighten us out on the Fed speak. Kaylee, the Federal Reserve is upside down. You've got Esther George saying we risk doing too much, and you've got Neil Kashkari saying we need to do more. Shouldn't those two be saying the other thing?
Right. We've seen a metamorphosis, a really remarkable one for the Hawks and the Doves. Neil Kashkari used to be one of the most dovish members of the Federal Reserve and is now out saying, I want 4.4% in 2023. And you forgot Jim Bullard yesterday as well, John. He, of course, has been the pusher from the beginning, the first to vocalize that he wanted to move of 50 basis points. Now he's saying in September, I want to go 75 again.
We're going to hear from Chairman Powell. Maybe he can straighten things out for us a week from today. We'll be in Jackson Hole, Wyoming for you. As we count you down to that big event next week, here's the price action to close out this week. We're negative 0.8% on the S&P 500, on the Nasdaq 100, down 1 full percentage point. Yields bleeding higher on a 10-year by 4 basis points. 292.43. You've got to tell us when you're out of cash, Tom. Crude 89 handle, down by 1.4%. And euro dollar, all of a sudden, Katie Lyons looking at parity once again.
Yeah, we are not even at 1.01 on euro dollar. So definitely something to watch as Europe, of course, deals with an energy crisis. And the UK is dealing with a cost of living crisis. And that is resulting to a summer of strikes. We have already seen it, and it is continuing today. A London Underground strike happening for 1 day only. Plus, you have pilots for Easyjet in Spain starting a 3-day strike today. It really speaks to the high cost pressures consumers are facing in pretty much everything about their daily lives. They want higher wages as a result, and it is causing some real issues with labor in certain European economies. Then, speaking of the economy, one very economically sensitive company will be reporting earnings this morning. Deere out at 6:45 a.m. Eastern Time. It, of course, is the biggest maker of agricultural machinery. How is it working through inflation pressures and, of course, ongoing supply chain challenges? To this point, it has been able to increase the cost it charges to its customers, and farmers have been willing to pay up because demand for food is so high. But how much does that continue, and what does the outlook look like going forward? Then finally, at 9 a.m. Eastern Time, the Federal Reserve President of Richmond, Tom Barkin, will be speaking. Who is he going to echo? Is he going to be more on the camp of Esther George, where they don't want to go too far, too fast, or more like Jim Bullard, who wants to move 75 basis points come September? I think the broad theme for these Fed speakers, though, regardless of whether they want to move 50 or 75 next month, John, they are really trying to push back on a market that thinks they're going to cool things off. They are all still broadly saying we have more work to do to get inflation down.
They've repeated that act repeatedly over the last month or so. Kaylee, are we done with earnings season after today? Is that it?
Pretty much. Deer's the unofficial close. We have more than 95% of companies in the S&P 500, so it's pretty sleepy from here.
Kelly's going to round it up for you a little bit later this morning. If you're just tuning in, good morning. Equity futures down 0.8% on the S&P. On the Nasdaq, we're down about 1 full percentage point. Joining us now is Seb Galley, the senior macro strategist on Nordea Asset Management. Seb, let's start here. You think the shock's ahead of us? Where and what in this market do you think is vulnerable to those shocks?
Well, if you look at how the market is evolving, it's trying to build a sense of confidence. Where are you going to get maybe a recession, a significant slowdown? And then when we pick up, and we know that once you can figure out when you get the pickup in economic activity in 2023, 2024, then it's awesome time for equities, typically because the Fed actually is reducing interest rates. And we're trying to trade way in advance of what we know. The reality is between now and probably 6 months, we don't actually know how to control inflation because we don't know what the neutral rate is. You're going to getting a bigger debate within the Fed. Their models are extraordinarily primitive and they just don't know. And so the consequence is they have to hike more than we expect. So 75 basis points is more likely. And we're probably going to see the Fed chairman next week confirming that view that they need first to tighten probably around 3%, then a long pause to assess the impact of interest rates. And it creates shocks, but it's also opportunities.
Seb, you're in Luxembourg. You're one of the most interesting continental people we speak to. How do you use the signals of foreign exchange, and particularly what we've seen literally in the last 18 hours?
Yeah, so what it tells you, if you look in the currency market, is that it's starting to trade like emerging market, particularly if you look at the UK and you look, of course, at Turkey, which is at the deep end, if you want to call it, within emerging markets. It's a higher yield, higher risk with people who take unorthodox measures. What it tells you is as volatility rises in the FX market from a very sleepy market, it's something which is not very attractive for a lot of people to invest in, to try to profit from. If they start to get worried, then that typically a forewarning for other asset class that volatility may be ahead of us. It's not necessarily the case, but there are different canary in the coal mines at different points in time in the business cycle. FX in the past has proven an interesting one, but not necessarily a very relevant one. Why? Because in many cases it's short-term in its views on the FX side within G10. Emerging markets a little bit more forward-looking, and sometimes it's also very forward-looking. So if it was easy, people would have back-tested it and would already be priced in. There are interesting elements within the FX market that it starts to trade like an emerging market and long dollar trade, which we all know. It's interesting. It's worth a study, but it's not necessarily the big thing that's going to explode.
Well, but it seems that a lot of the dollar strength we're seeing is no longer driven necessarily by the central bank or rate differential story. It's just about risk sentiment and a demand for haven. Other than the dollar, where can you find reliable safety?
Swiss franc, Norwegian krona. So north of Europe and south of Europe in the sense of Switzerland. Switzerland is just an awesome place in general, safe value, high quality of credit. It's just freakishly awesome to live in Switzerland in general.
Tom's going to want a road trip now.
So why aren't you living in Switzerland, Seb? What's up with that?
I made a huge mistake.
Seb, we could do a remote from Brasserie Lip in Zurich. I think that would really work out.
Are the people in Nordea listening this morning? Do you hear that, Tom? You made a huge mistake.
I have to move to Zurich.
Sebastian Galley of Nordea Asset Management. Seb, great to catch up, sir, as always. TK, did you read Marko Kolanovic of JP Morgan yesterday?
No, I missed that. I read him a couple days ago.
To this for a line. I'm not sure who this is for. While the perception is that the Bears were vindicated this year, one should keep in mind that price targets are for year-end and not intra-year lows. TK, some fire from the team at JP Morgan. What's that about?
But that's the emotion. No, I like it. That's the emotion right now.
Is that for his clients or his peers?
I think it's people recalibrating around clients who are miserable. How many people, John, are X basis points below the bogey, which is typically the S&P 500, not the Dow Jones Industrial Average? And, John, they're miserable. They're going into Q3, and they got to make it up by year end to make the bonai or keep their job. That's where this tension comes from.
Kelly, I'll get to the market call. Given our core view that there will be no global recession and that inflation will ease, the variable that matters the most is positioning. He went on to say, and positioning is still very low.
Well, that raises the question of what exactly has been the driver of the rally we have seen over the last 2 months. Is it really just a short squeeze because people were so bearish, maybe overly pessimistic, and now as things start to turn in a more optimistic direction, whether it's about a dovish pivot from the Federal Reserve or earnings that were weren't that bad. All of that positioning had to unwind to a certain extent. So if he thinks that he has further to go, he thinks that's going to drive us up to 4,800 year end. And we know that there are plenty out there who he may or may not be speaking to who are well below that, John.
Kelsey Barrow, I think, nailed it yesterday on this program. She said the big difference between the market and this Fed is 2023. The market's looking for cuts. The Fed's saying it's a hold strategy. President Daly, the San Francisco Fed, addressed this yesterday, Tom. I really think of the raise and hold strategy as one that has historically paid off for us. So we get the hold part of this. It's the race to what? Race to what on hold, Tom? And maybe we get some indication of that from Chairman Powell next week.
Again, Y-axis on radio, I got an arm up. That's the Y-axis. I got an elbow out. That's the X-axis. Daly's on the X-axis. So is Jim Bullard with a more optimistic view of the economy, John. These people are extending out. It's like the phrase, extend and pretend. They're not pretending. They're extending out to use time to heal the economy after the pandemic.
Let's wrap up earnings season, TK. Katie Deere just dropping.
Yeah, out a little bit early with EPS of about $6.16 a share. What's interesting is it actually has revised lower its outlook for earnings here when it comes to net income for the full year. The stock is down in pre-market as a result. I'm just looking through the statement to see as to why. We know, obviously, this is a very inflation and supply chain sensitive company. He says our results reflect higher costs and production inefficiencies driven by the difficult supply chain situation. That is according to the chairman and CEO, John May. And Deere right now down about 1.2% before the bell.
A little late.
TK, they've changed the range for year end. Full year net to come in at $7.0 billion to $7.2 billion. The range previously was $7 billion to $7.4. The estimate, $7.13.
You know, you mentioned One Direction earlier, John, and what Harry and Liam did, when, you know, about like when you and I met in Davos, it was
that was a One Direction moment.
You know,
Tom.
when I first saw you from across the room, I could tell you were curious about Euro Swissy. John, I hope you're sure what you're looking for, because the Dow Jones Industrial Average
I'm tearing
is
up.
it.
Tom, is this your way of saying you have Harry Styles tickets for this weekend?
I do. I have Harry.
You know, special.
It's just, you know, I go in one direction.
It's an X Factor type moment, Tom.
That was good.
Tom Keene, Kelly Lyons, Jonathan Ferro. Bramo happy she's off. Futures down 0.8% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Fed officials are offering mixed signals about the next interest rate increase. Their two-day meeting is set for September the 20th. One of the most hawkish policymakers, St. Louis Fed President James Bullard, backs a big move. He told the Wall Street Journal there should be another 75 basis point hike. Meanwhile, Kansas City's Esther George was more cautious. She said the Fed has already done a lot of tightening. The stakes just rose for November's G20 summit in Bali. The confirmation came from Indonesia's President Joko Widodo in an interview with Bloomberg's editor-in-chief, John Micklethwaite.
I know that you have invited President Xi Jinping to come to the G20. Has he said he will come here in November?
Yeah.
Xi Jinping will come.
And President Putin?
President Putin has also told me he will come.
Xi and Putin's presence would set up a showdown with President Biden and other leaders opposed to Russia's invasion of Ukraine. Meanwhile, European intelligence officials say Russia is probably using a nuclear power plant in southern Ukraine to shield troops and equipment. That's a tactic that undermines the security of the plant. The nuclear facility is Europe's largest. The US, UK, and EU have demanded access to the plant for international inspectors. And consumer confidence in the UK has fallen to a record low. GfK said its gauge of confidence declined 3 points to -44 in August. That's the lowest since records began in 1974. Concerns about a recession increased and soaring inflation tightened the squeeze on household finances. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
I don't think we're in a recession right now, but as we continue to raise rates, as we continue to raise costs, so to speak, of borrowing across the economy, it should be tapping the brakes on the U.S. economy, and that makes it more likely that we would end up in a recession.
Neil Kashkari there, the Minneapolis Fed president, rounding up some of the Fed speak from yesterday. From New York City this morning, good morning with Tom Keene and Katie Lyons. I'm Jonathan Ferro. Futures down 0.8% on the S&P. On the NASDAQ 100, down about 0.9% on the S&P. Just about set to squeeze out a fifth straight week of gains, the longest weekly winning streak of the year so far. Tom, we're up about 0.1% after the close yesterday.
Yeah, a little fragile to say the least. The VIX ought to stick 20.5 down. I don't know what to make of it, John. I can't correlate the foreign exchange gloom that we're seeing right now with the equity markets. They haven't clicked in yet.
Did you see Jordan Rochester of Nomura this morning?
What did he say? I
Looking
saw the
for
note, but I
downside
didn't
on
read it.
euro dollar from 10062 down to something like 97 by the end of September. He just does not think we're priced for the recession they expect.
And what do they do when they get to 98, 97 in terms of recalibrating? Right now, we're going to recalibrate in Washington. We do this with Jack Fitzpatrick, Bloomberg government reporter. Jack, the zeitgeist into the weekend is on a Senate that the Republicans were sure to take. They're not. And what they talk about is candidate quality. Dumb question, civics question of a Friday morning in the summer. Jack, who picks the candidates?
Oh, that depends. In this case, I think one of the challenges you're alluding to is that, at least indirectly, former President Trump, if he doesn't pick the candidates, has a huge hand in Republican primary victors. And as it pertains to the Senate outlook, you look to Pennsylvania, where the Cook Political Report just nudged that from a toss-up to a lean Democratic race. And it does look like Mehmet Oz is struggling a bit, not polling particularly well. There is a factor of Trump weighing so heavily over primaries, Republican primaries, that it can have a bit of a warping effect in who the most electable person might be in the general election.
The Senate might be an axis of Trump and McConnell. Is there a McConnell part of House Republicans, or does President Trump own the House?
The House has been more Trumpified than the Senate. To what extent, and do they move away from him? That's a big question that maybe the midterms will help answer. But if you look at the impact that Trump has had on the party in a variety of ways, in the way some members talk about foreign affairs, in the way they talk about fiscal policy, the Senate Republicans are still a bit more of the old guard Mitch McConnell types. McConnell is the leader of that caucus, whereas Kevin McCarthy and the House Republicans, I think by virtue of the fact that the House has elections every 2 years rather than 6, shifted more quickly to the kind of stances you see President Trump taking. They've been aligned more quickly with Trump in the House.
Okay, well, on the subject of President Trump, bit of an interesting day in regards to developments around him, Jack. First, you had a judge saying at least part of that affidavit related to the search of Mar-a-Lago needs to be released. And then you also had the CFO of the Trump Organization, Alan Weisselberg, pleading guilty to tax fraud. Which of those is of greater consequence to Trump himself?
I think overall, Trump himself, the Mar-a-Lago issues are of greater consequence, at least just because the plea deal with Alan Weisselberg it means that he has to testify against the Trump Organization, but that has not extended to Trump himself. There's much more of a possibility, at least it's apparent right now, in implicating the former president himself in these issues regarding taking top secret documents from the White House. If he didn't do it, there must have been somebody who did it. That's an issue that affects the former president personally much more clearly, although the Trump Organization issues can extend to him. There are a number of issues that I'm sure he is concerned about, but the Mar-a-Lago stuff could be directly facing him.
And of course, the Department of Justice, in regard to that affidavit, did not want it released because they said it would impede the investigation. Do we expect there to still be a battle over this, or is this now a done deal?
This is very much an ongoing issue. For one, the judge in this case has said he's not inclined to fully keep the details of the affidavit secret, but there's going to be a debate about how much they can redact. So the Justice Department has until Thursday of next week to say, here's what we want to redact. If they were to go overboard and say, well, let's put this out, but we redact absolutely everything, it could end up being taken out of their hands, and the judge would make the decision on how much information to put out. So there's still a huge X factor in terms of how much information goes out to the public. If this really does affect continuing investigations in terms of revealing how they got the tip that these documents could have been in Mar-a-Lago, there are probably many other shoes to drop in that investigation.
Hey, Jack. Thank you, sir. Jan Fitzpatrick down in D.C. Serious issues. Less serious one. Kaylee, have you seen the video of Dr. Mehmet Oz doing the shopping?
A little grocery shopping.
What did he call the grocery store? Wegner's.
Yes.
Wegner's. There were two stores, Redner's and Wegmans, and he just sort of mixed them together because people assume he's actually not from there.
Yeah, I'm not going to comment on that, John. All I will say is get a cart or a basket or something.
You weren't happy.
Just going
you were
around the
unhappy
store
with the fact he did it just with his
things
hands.
in his arms. You know,
you're very critical. There's more wrong with it than that. That one little thing. TK, have you seen that video?
Yeah.
As he goes around shopping for the crudités.
I think a lot of it is trying to do old campaign style in a new modern day with the speed of social media and all. It's just the old. I'm not sure the old stuff works, John.
Do you have asparagus with salsa, Tom? That's what I want to know.
What?
Asparagus, do you have that with salsa? Because that was the shopping he was. You haven't seen it, have you? Tom, you need to catch up with American politics, sir.
I'm
surprised
I'm
that you're
busy listening to One Direction.
You're not dialed in
at
all.
Harry's got something new out, and I'm listening to his new project.
Are you going to watch him here in New York?
He dropped a couple days ago. See,
okay.
I know the language.
Well, you're up to speed on the important stuff.
Got it.
TK's got that, Kaylee. We'll take care of the rest. I'll take care of the markets. We're down about 0.8% on the S&P 500. On the Nasdaq 100, down about 0.9% this morning. Equity's a bit softer as we look to try and squeeze out a week of gains. We're looking at a day of losses that could take out that week of gains. This from Michael Hartnett of Bank of America this morning. Bear rips always narrow. Of the 17.4% gain we've had off the lows, just 4 stocks, Apple, Microsoft, Amazon and Tesla, Tom, contributed 30% of the gain.
He is way correct. It has been incredibly narrow.
We're going to catch up with Steve Cheverone of Federated in just a moment on that story. Looking forward to doing that. Right now, futures lower from New York City. Good morning to you. Heard on radio, seen on TV. This is Bloomberg. Here's a stat from Michael Hartnett and Bank of America and the team, and good morning to you. 43 bear market rallies of more than 10% since 1929. The average, 17.2%. What have we just had off the lows? 17.4%. What does Michael Hartnett say? Textbook. Bear market rally. We pull back now. Futures down 0.8% on the S&P 500. On the Nasdaq down about 0.9%. Bit of weakness to close out the week as we anticipate what Chairman Powell will or will not say next week. That speech has been confirmed in Jackson Hole at 10 a.m. Eastern Time.
Oh, he'll be there
next Friday. He will be there. TK.
Zoomy.
It's not zoomy. He'll
John,
be there.
do I look okay? I'm doing my
zoomy.
Dr. Oz look.
What are you doing?
I'm carrying all my stuff at my desk
now
around.
You've seen the video.
See, now I'm all zeitgeist.
Now you're dialed in. We can talk more about that in a moment, Tom.
Yeah,
I love this. This is ridiculous. Anyway, let's get to the bond market. 2s, 10s and 30s shaping up as follows. 2-year yields last Friday, 3.24. Your 2-year yield this morning, 3.24. Your 2-year has done a lot in between the week, but is closing basically where we were last Friday. Yields this morning at 5 basis points. On a 2-year, on a 10-year at 4 basis points as well. That curve inversion just eases a little bit through the week, just a little bit, with a 10-year climbing a bit higher. That's the bond market. I want to finish on foreign exchange and take a trip over to Europe. Both cable and euro dollar. Sterling. UK consumer confidence, the lowest since 1974. Just think about that. Brutal. Sterling 118.52. That's a quiet slide, Tom. We haven't talked about that much. Cable down 0.6%.
This is a big deal. And on euro sterling, where you triangulate them over, it's stronger euro versus sterling. I mean, yeah, it's a joke, but come on. The United Kingdom is an emerging market. This needs to be discussed.
It's brutal. Just like Katie with the set right now, Tom. I don't know if you heard that, but, you know,
I was laughing too hard at Tom.
Pulling things apart around here, TK, so we've got to go.
You know,
Euro dollar negative a third of 1%. Euro dollar, Tom, just above parity.
You know, we got to do a McKinsey study and see if we can get a Kaylee cam put in.
Like a Bramo cam.
Yeah, like a
just Kaylee tearing up the set, Bramo getting annoyed at equity market bulls.
Yeah, Kaylee,
there's sell, Tom, pay-per-view.
There hasn't been enough gloom with Kaylee Lines this week, so we're going to go to Steve Chivarone right now, head of multi-asset solutions at Federated Hermes. And Steve, what's so important here is Steve Auth and all of your stock leadership are inherently optimistic about the American experiment, about the owning of equities. But right now, Federated has a gauze of gloom over everything. Is that gloom a 3-year horizon or is it a 6-month horizon?
No, I think it's somewhere in that kind of 6 to 12 month, range. I mean, Tom, we are bulls, and we have been bulls for the better part of 15 years. Structurally, because we think that's right. Markets move higher 3/4 of the time, and there's unlimited upside. But when we look at the economic conditions and the market conditions in front of us, it leads us to a more cautious place. And we've got to be objective there, and that's why you hear us be a bit more cautious than we've been historically.
Just as a blended idea, what is your cash position? Are you running long only buy side at 2-4% cash? Have you blown it out where you're in with a general counsel saying we got to be at 15% cash, or is it in between? Where are you as cash percentage?
Yeah, so within our mainstream asset allocation models, we're somewhere pushing towards 10% cash, which is the high end of the range that we go. I think we'd like to put that to work in some longer duration treasuries. But I suspect if the Fed continues with this dovish rhetoric and the market starts, warming to the idea that they're going to be hiking for a little bit longer, you're going to get higher yields that will allow us to buy those treasuries at more attractive prices. But that's one of the trades that we're looking towards.
Steve, have you got a historical parallel that you're clinging to right now? Does anything work? What's the playbook?
Yeah, look, I think you've got lessons from a bunch of things. If you look out at the world, right, you've got geopolitics that look like, 1939. You've got tech valuations that look like 1999. You've got inflation that looks like 1979. So, there's a number of historical parallels. I think what we're looking at is how is the Fed really going to come down here? They run a risk, and I know that they're worried about over-tightening, which they should be, but they run a risk if they pull up too soon of repeating the stop-and-go errors of the 70s. On the other hand, if they go too far, too fast, the recession that comes could be more severe. I think the thing to keep in mind is there have been 9 hike cycles since 1970. 7 of them ended in a recession, and the 2 that didn't certainly felt like recessions. So that's your starting place.
Steve, John has brought up the latest research out of Michael Hartnett at Bank of America a couple times this morning, and one of the lines in his note was very few fear the Fed. And I'm wondering, as we're having a conversation about over-tightening, is the market expectation that the Fed isn't going to want to over-tighten as a result, equities are rallying, financial conditions are easing, actually going to be the thing that causes the Fed to over-tighten because they have to rein that in?
The Fed's actions this year haven't, they've been pretty reasonable. I think they were late starting, but, the aggressiveness with which they've hiked has been reasonable. But their rhetoric and their communication strategy just has left a lot to be desired. And so for all the peaks that we talk about, I think it's peak Fed credibility that we have to worry about. And what I mean by that is, you're in a scenario where the Fed said, well, look, we're not backing off until we have compelling evidence that inflation's heading back down to 2%. We go from 9.1 to 8.5 on the back of a little bit of softer commodity prices, and the minutes are reflecting, debate about how far we should go. There's a disconnect there. And then even with the members, you have the, Fed Chair Powell saying we're close to neutral at the press conference, and then every Fed governor comes out afterwards and essentially contradicts him. So it would be nice to have a much more consistent communication strategy, because you're right, the market is doubting in either direction, in line with their own bias, what the Fed's going to do, and they're not helping. So he has an opportunity at Jackson Hole, once again, to try to provide some more direction or a consistent voice. We'll see if he does it.
Yeah, so if there's a mispricing in the equity market that's too optimistic about the Fed pivot, what about the bond market? Because we have seen yields moving pretty substantially higher off the lows. We're back at 293 on the 10-year. What's appropriate given your expectations of Fed policy?
Yeah, look, I think when you look historically, you've never gotten high inflation under control without a federal funds rate that exceeds the inflation rate. Now, I don't think we're going to 10%. I think inflation will come down as the economy slows. But you've got to start, the market has only allowed itself to price in 3.75 in terms of the terminal rate here. I think that number's probably got to go closer to 4.5. And so as the market prices that in, I think you're going to see yields rise. And it's not just the level, it's the duration. I think it's right. The Fed will at some point cut because growth is slowing too quickly. I just don't think that that's a first half of 2023 event. I think at the earliest, that's a kind of late 2023 event. So rates, I think, are going to go higher. I think they're going to be there for longer. And I think the bond market has one more opportunity to kind of price that in, at which point we would probably buy those treasuries as we think, they'd rally on that economic slowdown.
Steve, I've got a 201k with the way I've been in cash for so much. It just hasn't worked out. For retirement plans, are you reallocating here or not? I mean, with a 3-year, 5-year perspective, do you get cute in late 2022?
Yeah, I think for a retirement plan, for a longer-term plan, what you're trying to do right now is be defensive and then gorge next year. I think you're going to see high-yield bonds in the back part of next year with really attractive yields. If you think about a 3-year federal funds or 3-year treasury at peak, and then you could have spreads in that kind of 800-900 basis points range. Those are going to be attractive. I think you're going to be able to buy tech stocks under 20 times earnings. I think you're going to be able to buy cyclicals. And so it's not getting too cute now. It's staying close to neutral. It's staying close to the vest. We're neutral stocks versus bonds. We're overweight cash. And then when sentiment is really poor, at some point next year, we would look to kind of gorge on those risk assets and set those portfolios up for a long-term run. We're just not quite there yet.
Steve, just finally and quickly then, what would you sell today to raise cash for the opportunities you expect tomorrow?
Listen to you.
Yeah. Look, I think the rally we've seen in some of these tech stocks, they're just too high. They're still trading at 25 times, and we think they've got to trade somewhere closer to 19. So we would be inclined to sell tech here, and for the time being, buy defensive dividend-paying stocks. And that's the sell. What ran here was the junk outside those couple of big names that are high-quality tech. But in general, what's run is the junk. And I would fade that in favor of higher quality equities and higher quality bonds.
Steve, how do you feel about asparagus with tequila and salsa? Does that work?
I think it's blasphemy, and I don't want any part of it. I like my tequila neat.
He's a fancy.
I imagine you like your asparagus cooked as well. Steve Chevron there.
Well, certainly not raw. Certainly not raw.
Steve Chevron there, a Federated. TK.
John, can I weigh in here?
Sure, please
literally, honest to God, one of the Wegmans way back was a campmate of mine in the summer, long ago in Far East. Wegmans is a Rochester, New York institution that everyone respects within the food business. Here's the reality. I think, Amy, we've got the video here of the senator to be, I should say, in Pennsylvania. And for those of you on radio, it is the well-coiffed Dr. Oz walking the aisle of the perfect Wegmans produce section. John, the problem here is if you want to win in Pennsylvania, you're not buying organic asparagus and the rest of it. I mean, Wegmans asparagus, they sell like 3 things a week, 1.5 pounds at $5.24 each. If you want to win in Pennsylvania and Western New York, there's one way, Dr. Oz. Zweigel's sausage premium pop open cooked whites. You got to buy, John.
$6.99.
Zweigel's hot dogs at $6.99 each. Now that's a breakfast that leads to victory in Pennsylvania.
Katie, what are they selling Tang for?
$3.49, Tom. I think that's a bargain.
$3.49 Tang, TK. Is that
That's
a good
not
price?
Bad. It's
not bad.
It's good because then you don't have to drive to Costco and wait in line.
I can see you doing one of these shopping trips, Tom. Then blaming the president at the end.
Yeah, but if you want to win in Pennsylvania,
and getting the name of the store wrong because you've never been there.
Republicans, Pennsylvania, you're buying asparagus? Come on.
And dipping it in salsa? And wondering whether you should add tequila to it anyway. Okay.
You buy a case of Schaefer beer. That's where you start, and you follow up with some Zweigels and something from Philadelphia and Pittsburgh that gets it done.
We're a few days late to this story, but I'm pleased we finally made it.
It's team coverage.
It's great.
It is.
Futures down 0.9% on the S&P. Futures down on the Nasdaq by 1 full percentage point. Equity's a bit weaker here. Yields a lot higher.
That's
by
an
4
FX
or 5
story.
basis
Come on, John.
points.
FX.
290, 280, and a dollar stronger. Euro dollar negative about 0.25%, just above parity. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A judge says that part of the FBI affidavit used to get a search warrant for Donald Trump's estate should be unsealed. The judge has given the Justice Department a week to propose what should be blacked out. News organizations and others have asked for it to be released. China has reported the worst week of COVID infections since mid-May. They've been fueled by outbreaks in vacation hotspots that risk spreading across the country. There were more than 18,000 new infections in the week that ended Thursday. And the influential sister of North Korean leader Kim Jong-un has rejected a disarmament for aid deal offered by South Korea's president. Kim Yo-jong called it a stupid plan, and she said that North Korea has no intention of getting rid of its nuclear arsenal. Even if your company isn't planning layoffs, the one next door is. That is according to a study by consulting firm PwC. It polled more than 700 U.S. executives and board members and found that half said they were reducing headcount or plan to. 52% have implemented hiring freezes. Qualcomm is planning a return to the market for server processors. Bloomberg's learned the company is seeking customers for a product stemming from last year's purchase of chip startup Nuvia. Amazon's cloud business has agreed to take a look. A successful product launch could help Qualcomm decrease its reliance on smartphones. And shares of Bed Bath & Beyond are still plunging. Investors reacted after that news that billionaire Ryan Cohen has sold his stake in the struggling retailer. Cohen pocketed $68 million, a 56% gain in an investment he had held for 7 months. But retail investors are feeling the pain. Their net purchases of Bed Bath & Beyond surged the last 3 weeks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We still have China in lockdown. We have large parts of Asia also in partial lockdown when it comes to international travel. And I think that's going to open up in the next 6-12 months. We are down 25% on jet fuel demand globally from pre-COVID levels. We could see a pickup of 500,000 barrels a day, maybe more, just on that front alone.
That was Francisco Blanch of Bank of America looking for maybe a return of higher crude prices from New York City this morning. Good morning. With Tom Keene and Kelly Lyons, I'm Jonathan Ferro. Lisa back with us on Monday as we close out this trading week. Looking at some weakness this morning. We're down 1% on the S&P. We roll over on the Nasdaq, negative 1.15%, call it negative 1.16. In the FX market, some dollar strength, some euro weakness. Euro dollar clinging on to parity, 10061 this morning, negative 0.25%. It yields a lot higher too. Let's call it 5 basis points higher, Tom. 292.98 on a US 10-year.
It's interesting to see. We're watching foreign exchange particularly. We've got Jane Foley coming up as well to give perspective, other good guests. Right now on the airlines, and it is something, we've all got our stories about trying to get back to travel, trying to get back to normal. It's not. Savi Sith joins us, Airlines Managing Director at Raymond James. Savi, I want to get this out of the way right now. On a buy, hold, sell basis, which is the American airline to believe in over the next 3 to 5 years? Which is the stock that's getting it right?
Hey, so Tom, yeah, I think Delta is probably a good stock to own here. There's a lot of uncertainty. This is a cyclical sector. But I think you got quality there, a good balance sheet, and customer service that's returning. So that's probably the stock too.
My colleague Savi Paul Sweeney's got me into looking at the app where I can watch the airlines take off. Last night at Newark, EWR, I basically saw controlled chaos. There were 17 planes in perfect weather trying to get up in the air. How did we get here where the actual physical airports are a mess?
Yeah, the issue with the Northeast, though, is, and this has always been an issue, is and you look out, it's perfect weather, but weather in Pennsylvania, the weather in that whole corridor matters to the airport. So it's long been a frustration. And on top of that, you're layering on more recently air traffic control staffing that's lower than in the past. You're You have kind of just across the supply chain at the airlines and the airports, just staffing levels that aren't, back to the productivity that we saw pre-crisis. Hopefully, as we kind of go through the following months, hiring picks up, people gain more experience, some of these issues should resolve. But unfortunately, the Northeast airspace is a longer-term issue that needs to be resolved, and maybe using next-generation air traffic control systems.
Well, and of course, that's not just a U.S. story. That's a global story when you look at what's happening with airports and airlines in Europe. The Easyjet pilot strike in Spain beginning today, lasting 3 days. We know what's been going on at Heathrow with everyone from the people on the tarmac on strike. As we talk about how fuel pressures have come down a bit, what about the wage pressures? Are those now going to be picking up as the people employed by the airlines demand more because of inflation?
Good point, Kaylee, because and that's probably going to be different on this side of the Atlantic versus the other side, just the way the labor contracts work. But you make a really good point. In the U.S. last year, you had a lot of the gate agents, ramp agents, where they were struggling to staff, and so you saw a lot of wage increases there, about 25% type increases for entry-level positions. But that's a very small portion of overall airline labor costs. What we haven't really seen is flight attendants, pilots, mechanics, those contracts that became amendable right around before COVID or right around COVID, which usually would have been amended by now, that hasn't gotten done yet. We think it will get done in the next 12 to 24 months, and you're probably going to see pretty big wage increases there. And so it's still a big cost increase yet to come for airlines here.
Okay, Savi, so that's what the airlines are paying their people. Let's talk about what me and everybody else is going to have to pay to get on the plane itself. Have we seen peak fares and pricing power? Is it all downhill from here?
I think we've seen peak fares for the reason that, earlier in the summer, you had this kind of perfect storm of, for various reasons, capacity that was being constrained and capacity that was probably about 10 percentage points below demand. And as we go through, I think capacity is finally going to catch up to demand. It also happened at a time where fuel was, it doubled in a very short period of, nearly doubled in a short period of time. And you have seen fuel pull back a little bit. Now that will be somewhat offset by labor costs that are coming. But I do think you're not going to see the level of pricing that you saw earlier this summer. But because of that labor cost, right, I think it'll still be somewhat elevated.
Savi, I want to go small here. I want to go from Grand Forks, North Dakota, where you schooled, 82 miles south, to Fargo. If I want to fly from Fargo to New York, it's almost cheaper to go to Minnesota, to Minneapolis, to fly out. Is American aviation giving up on smaller cities?
Not completely, and I think Fargo is probably going to continue to have service. But you're right, there are these pockets of areas that airlines are struggling right now because of pilot supply to serve. And I think that will get resolved over time. But it is for small cities, you're going to see maybe less frequency, or in very small cities instances, maybe no service, and that service getting dropped. And the result is a pilot supply issue, and a pilot cost issue. These are kind of 50-seat aircraft that it really gets hard to spread that fixed cost out as pilot wages move up.
Savi, awesome to get your thoughts on this industry. Savi Sither of Raymond James, an industry we've all got an opinion on right now. TK, are we flying together next week?
I don't know if we are or not. I don't know. My people haven't briefed me on that.
Okay.
I don't know.
Just trying to work out travel next week.
I got a thing, and they go, "Do you want to fly into Omaha and take the wagon train west?"
The wagon train.
Save money.
How long does the wagon train take?
Yeah, well, it depends. If you get to Kearney, Nebraska, you just begin to see the Rocky Mountains in the distance. So it's a little bit of a trip.
So you're going to take the wagon train from Sunday, and I'll see you on Wednesday evening, maybe Thursday morning.
We got a huge response. I mean, the $1 Million Bar, John, it just beckons for you and me.
Okay, we'll work that out. We'll do a live blog of it, Tom.
Yeah,
a video blog. That'd be cool.
Shenandoah's there the week after.
Let's ignore that. We're down about 1% on the S&P. On the NASDAQ, Tom, we're pulling back. We're pulling back by 1 full percentage point, with the yields higher by, let's call it 5 basis points, Tom. 5 basis points to 293.
Just since we started this epic show, John, we've got stronger dollars. Yeah, we're up to 108 on DXY. We're really getting right there. And, we're making jokes and all that. It's Friday in the summer. We're waiting for the autumnal foliage to click in. You know what, folks? There's a lot going on in the market.
This is super defensive this morning. We've got yields up, dollar stronger, equities lower, Crude
it's
lower.
Way dollar stronger.
Kelly, crude lower by, let's call it 1.9% right now.
And how much of that is the China demand story, John? I was looking at Asia overnight. It was down just like everything else, but it really feels to me that that is what is dragging down that entire region. Expectations of Chinese growth getting much, much lower. 2.8% is what Nomura said they're looking for this week. And despite the pledges of stimulus we've seen over the past couple of days, the market just doesn't seem to buy it.
Have you got an airline rant that you'd like to share?
No.
Just some complaints?
Yeah,
No? You're good? All right.
Yeah, I will not check a bag, though.
You won't? I won't
on
do that
any
either.
flight.
I won't do that either. I went to see my mum. She wanted to send me back with stuff. I said, absolutely not. Carry on only. I will not be checking a bag. TK, checking a bag next week?
Yeah, I take 4 or 5 usually.
You're taking bags next week?
I look like
He has a
Audrey
lot of
Hepburn in
hats, you know?
Charade.
There we go.
The market has unfortunately undone a lot of the hard work that the Fed had been doing over previous months.
The market thinks basically in a year's time, inflation is going to be back at 2.5%.
We still think that the Fed has more to go and then also will ease policy less next year.
I do have confidence the Fed will eventually do what's necessary and that we'll ultimately get back to something close to 2%.
The real divergence comes in 2023, where the market is pricing rate cuts and the Fed is expecting to continue to hike.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
A really defensive Friday morning from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance with Tom Keene. I'm Jonathan Ferro, together with the brilliant Kelly Lines. Lisa back on Monday. Futures down about 1%. TK on the S&P, on the NASDAQ down by 1.1.
Here's a message. Stay with us through the hour. Jane Foley along the way. We'll talk about her foreign exchange off the desk in London. And John, I just got to say, foreign exchange speaks volumes this morning about the tensions out there.
Jordan Rochester looking for another move lower on euro dollar. Tom will pick up on that theme. Barclays pushing back this morning, saying we're set up for a reality check from Chairman Powell next week. And Michael Hartnett of Bank of America, Tom, out a couple of hours ago, just calling this a textbook bear market rally off the June lows.
Well, let's be clear. There's some of these strategist folks can stop the market cold. And Hartnett did that a couple days ago, John. We were at an up feel. Hartnett published, and boom, we went down stochastically, as I'd put it, like a rock, if you will. And, you know, that's the sweat into the weekend. It's not a normal, lazy Friday summer weekend.
Summer weekend, Tom, just around the corner. I have to say, Marko Kolanovic pushing back against all of this, Tom.
Yes.
Price targets for year end. They're not for intra-year lows. That from the guy over at JP Morgan, Tom, just yesterday.
I wonder if everybody's going to recalibrate earlier. Are we going to see the third quarter write-up September 26th? Is that going to happen August 26th?
The Kelly Line super defensive going into Chairman Powell next Friday.
Yeah, basically the only thing it looks like people want to buy this morning is that dollar. Equities lower, bonds selling off as well. It just seems to me that risk is getting taken off the table. We also have to keep in mind there's a massive options expiration today, I think $2 trillion worth. So that may add some volatility that really largely has been absent for a lot of parts of this market, John.
And we've wrapped up earnings season.
Indeed.
Kelly Lines, it was not as bad as people expected it to be, as is often the case with earnings season.
Yeah, it's a question of if we were too pessimistic coming into the second quarter, are they still too optimistic about the picture going forward? Because as you say, John, most companies beat expectations, but the bar was a little bit lower. And so I wonder going forward, are we starting to see maybe more revisions, downward revisions to those earnings estimates? That's what the likes of Mike Wilson at Morgan Stanley have been warning about for some time. And I wonder if he read Kolanovic in the last 24 hours.
We know and love. I do wonder whether that was a dear Mike Wilson note from Marko Kolanovic yesterday. Was it for his peers or his clients? We'll talk about that later. Futures down 1% on the S&P 500. On the NASDAQ, we're down about 1 full percentage point. We're softer this morning. Yields are higher by 6 basis points on a 10-year. 2.94 euro dollar negative to 10059. We're down about 1/3 of 1%. Katie Nye, some euro weakness, some dollar strength.
Yep, not just euro weakness. Basically, everything is weaker against the greenback today. Not so much about the central bank rate differential story. That really is a bid for haven, given all the risks out there around the growth story and geopolitical risk as well. Now, there's a number of risks Europe is facing. That is why you're seeing the euro weakness playing out. And in the UK, there also is risk, and that is in the form of labor. It is the summer of strikes that continues today with a strike on the London Underground. All of our colleagues over at London headquarters are going to have difficulty getting home today. Plus, Easyjet pilots in Spain are also on strike for the next 3 days. It is the cost of living crisis pushing labor to push for higher wages. Of course, wages is something the Fed is keeping an eye on as well. We'll hear from one Fed speaker, Tom Barkin of the Richmond Fed, at 9 a.m. Eastern time. Where does he come down in the chorus of voices we have heard this week? Is he more on the camp of Jim Bullard, who yesterday says, let's go 75 again in September, or more like Esther George, who would like to take it easy and not overdo it? So we'll wait to hear from him. Finally, in the commodity complex, as it relates to energy prices, 1 p.m. Eastern, we'll get the U.S. Baker Hughes rig count, basically just a read on shale and supply, how much they are drilling. We've been focusing so much on demand in the oil market in recent weeks, Sean. But about supply, are we still underestimating the constraints that are out there in the oil market?
Just to mention, I've got a great video somewhere of Manus Cranny and I, maybe 10 years ago, trying to get back from the City of London to West London, Tom, with the tube shut down. And we tried to do it on London buses and had absolutely no idea what we were doing. I think it took us 3 hours.
Yeah.
In the traffic.
I mean, but this is indicative of what we're going to see with the inflation that's out there.
What's that, Tom? More strikes?
Sure. I think a primal scream from labor. Yes.
Going to see a lot of it. Yeah. Futures right now down 1% on the S&P, on the Nasdaq, down 1 full percentage point. Joining us is Michael Schall, the CEO of Market Field Asset Management. Michael, about 30 minutes ago, Steve Chevron of Federated came on this show and just said sell tech stocks. Do you agree with that?
I think the S&P's had, a really powerful bounce, and I think you're back at a level that I think it's easier to see the next 500 points being down rather than up in the S&P. So I'm not sure I would particularly pick on technology, but I think this is a market that you can look at, and if there are stocks that you hung on to in June and you don't feel great about them, I think this is a reasonable chance to say goodbye to them.
I find it fascinating, the back and forth. You've always been so thoughtful about what to do with a portfolio. Do you have a conviction now, or is it a summer of shoal uncertainty?
I think that we're in the middle of a significant tightening by the Federal Reserve, and that will involve at some point a real market panic. I thought we were close to it in June. I think the market held its nerve, and you've had, I think a typical reaction to that. I'm uncertain how long this bounce goes on for, but I still think we have a period of significant volatility ahead of us before year end.
Well, of course, Michael, the Fed would like to see financial conditions tighten. That is what they are aiming for. That is the goal of the rate hikes they are implementing. And we know that for the broader economy, that will operate with a lag. But in theory, it should already be affecting the market. And yet what we've seen is financial conditions getting looser. Even as the Fed waits for that lagged effect for the economy, are they just going to have to be more aggressive now to signal to the market, hey, we're serious, and that risks them ending up too tight?
That's a great question. I'm not sure the Fed directly targets financial conditions. I believe the Fed targets inflation and believes that by tightening financial conditions, it kind of gets there. Now, I think one thing which has gone well for the Fed over the summer is that finally some of the sort of transitory effects which they were looking for last year have been delivered. So they have a little bit of a breather in terms of inflation. In terms of financial conditions, I mean, they reflect what I just said about the equity market. We're back to almost exactly zero in the Bloomberg Financial Conditions Index. That reflects an S&P which has had a 50% recovery of its bear market and credit markets, where spreads are, I would say back to the high end of normal. I'm not sure the Fed directly targets financial conditions. I mean, and if I'm right and you have a period of volatility ahead of you, that's something that's going to fix itself. What I would say is that the Fed is not scared of financial markets at this point. And so what that does is open the way to more aggressive rate hikes if they feel like doing that. Whereas back in June, I think the Fed is looking at financial markets and thinking whether or not it can get away with a 75 basis point hike or not.
What are you expecting from Chairman Powell next week, Michael? What will you look for?
I think he's going to try and keep his options open. I think he's going to repeat the mantra that the Fed is very serious about controlling inflation and will do what it takes. It's the sort of reverse Mario Draghi, but it's the same quote being used. But I think he's going to try not to commit. This is not going to be Ben Bernanke in 2010, where he telegraphed QE2 3 months ahead of time. Powell understands, I think, that it's a tricky situation here, and he'll do his best to not say very much.
Michael, the truth is we don't care what you think about the markets. We went through our surveillance Rolodex,
yes,
and
yes.
Ferro
You wanted a Manchester United fan.
Ferro, there's points where Ferro thinks he's taking over.
Yes.
He had a total tantrum and said, get Shaul on Man U. John, pick it up on Man U.
Go on, Michael, let's go there. What is going wrong with your football club?
I think it's just a horribly managed organization. It's not just for the football itself. I mean, it's just a shocking series of really mediocre decisions made at the most senior level of the club. By ownership that, in my opinion, should never have been allowed to buy it in the first place.
How can they not sell a $6 billion asset with that capital gain? I mean, don't they have almost a moral duty to unload it here after Chelsea?
I think the price that Chelsea got probably alerted some people in the household. But I think they've always taken the view that sports is one of these, almost like technology, but it's always valued more. Look, I don't know. I'd be delighted to see a change in ownership. Although, I'll be honest, there are worse. I'd rather be owned by a family than a country. That's just my own personal feelings.
And Michael Shaw of Marketfield Asset Management, with a subtle dig maybe at the other club.
For radio, John, what do we think about the fact he's wearing a Man City tie today, even though he supports Man U?
I missed that, Tom. I actually missed that.
It's like confusing.
I think he's going to wear red next time.
Can we just take a moment to say we also appreciate Michael Shaul's opinion on the markets?
You think?
That was...
Bramo would never say that.
It's all good. It's all good.
Kaylee, come on. You got to toughen up, Kaylee.
Kaylee, come on.
I'm plenty tough, Tom.
Come on. Michael Shaw. Thank
Bramo
you very much, sir.
Thank you.
Bramo's plenty tough as well.
Yeah.
Bramo's back next week. And coming to Jackson Hole, too. You coming to Jackson Hole with us, Kaylee? We're going to make that happen.
I wish.
That
I would
means
bring my bear spray.
Your show would start at 3 a.m. Eastern time.
Yeah, then that's going to be a no.
Or rather 3 a.m. local time.
But I look forward to watching your coverage.
Thank you. You look forward to us in the dark and the freezing cold at 4 a.m. local time, working through a look ahead to Chairman Powell. That'd be fun, TK. TK, I thought you were hand luggage only next week. I thought we sorted that out.
No, we did. Seriously, hand luggage only.
Hand luggage only.
It's some of the stories I've heard this year are brutal.
I don't know anyone who wants to check a bag, TK.
Yeah.
That is a high-risk strategy.
It's
for a business trip and
a vacation. John, you're more on this than I am, but you got to say why. I mean, what is different now versus November of 2019 in terms of baggage?
They don't have the staff, the baggage handlers, Tom.
Pay them more.
I pay them more, then you've got to get them security clearance as well. At certain airports, that takes a while. It takes a while to ramp this back up.
Give them free Man U tickets. I don't
know if that scares them off at this point, Tom, or encourages them. Coming up, we'll catch up with Patrick Armstrong of Plurimi. Got to squeeze this in. Special birthday today, Tom. Happy birthday to Mohammed Al-Arian.
Oh.
A very, very happy birthday to
Is he going to buy Queen's Park Rangers?
I'll have a chat to him. See if he'll take a minority stake in Manchester United. Futures down 1% on the S&P from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Fed officials are offering mixed signals about the next interest rate increase. Their two-day meeting is set for September 20th. One of the most hawkish policymakers, St. Louis Fed President James Bullard, backs a big move. He told the Wall Street Journal there should be another 75 basis points hike. Meanwhile, Kansas City's Esther George was more cautious. She said the Fed had already done a lot of tightening. European intelligence officials say Russia is probably using a nuclear power plant in southern Ukraine to shield troops and equipment. That's a tactic that undermines the security of the plant. The nuclear facility is Europe's largest. The US, UK and EU have demanded access to the plant for international inspectors. And the biggest producer of the nickel used in electric car batteries wants to be seen as more than just a repository of resources. Indonesia's President Joko Widodo spoke to Bloomberg's editor-in-chief John Micklethwaite.
Yang kita inginkan semua adalah mobil listriknya.
What we want is the electric cars, not the battery. For Tesla, we want to build electric cars in Indonesia. From Ford, electric cars, Hyundai, electric cars. From Japan, Toyota, Suzuki.
Akan menjadi.
And we want a huge ecosystem of electric cars.
Indonesia's held talks on potential partnerships with Tesla over several years, but there have been no agreements. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
doesn't know where it is, that the world is very ambiguous at this point, and minutes of a meeting are a very poor way to convey a collective message.
Larry Summers there on the same page as Tom Keene, the former Treasury Secretary. Look out for more from that alongside David Weston on Wall Street Week later this evening. Live from New York City alongside Tom Keene and Katie Lyons this morning. I'm Jonathan Ferro. Lisa back with us on Monday. Equity futures negative 1 full percentage point on the S&P, on the Nasdaq down about 1.1%. Yields higher by 6 basis points now on a 10-year to 294.45. So yields climbing, equities dropping, crude down by 2% to 88.59. And just to round out a defensive morning, some dollar strength for you. Euro dollar threatening to break through parity again, Tom. Euro dollar 100.57, a negative 1/3%.
Watching DXY, the more broader trade index, I should say more narrow trade index, 108. We haven't touched yet, but we're getting there in moments. Bloomberg dollar index, a much broader, more complex series showing strength of 0.5% on dollar today. And again, sterling really leading the way here, 118.43. We will be in Jackson Hole next week. It's not a lot of fun and games. You go out there, it's 38 degrees. It's cold in the morning. We got a great team ready, and we're really lining up exceptional guests. One of those scheduled not to speak with us is like the silence of the lambs. It's the silence of the Treasury Secretary. Jack Fitzpatrick joins us now to get ready for Jackson Hole. Jack, where in God's name is Janet Yellen?
That's a fair question. I think the Biden administration pretty broadly has tried to let the Federal Reserve speak. If it's on inflation concerns, saying, look, the Fed takes the lead on this. Yellen, for her name recognition and her prior roles, has not been super vocal. That may be a product of the White House struggling to figure out how to talk about the economy lately. It is a bit surprising that she hasn't necessarily been a more high-profile cabinet secretary. I'm not sure I have an answer for exactly why that is, but it's tough. It's been tough for them to figure out how to talk about the economy. When it comes to inflation, a lot of the time the answer has been, well, that's the Fed's job.
Yeah, I get that, but I mean, should she be taking a victory lap for the legislation just signed by the president?
It might be difficult for her to take the victory lap. For one, yes, the administration is excited about it. They ended up getting there in part by stepping back and letting the Senate just figure out what they could do. Maybe there will be more of a victory lap. Remember that they had the bill signing, but with Congress out and many lawmakers not there, they're going to have further events with cabinet secretaries where they talk about how they're implementing this. On the Treasury stuff, it's a bit of a dicey politically issue. I don't think the Biden administration wants to play up the IRS components of that very much. That's something Republicans are campaigning on. So I don't know that that's necessarily something that lends itself to Janet Yellen taking center stage. And I'm not sure anything has lent itself in a politically advantageous way to her taking center stage.
Well, and of course, the domestic politics is only one thing that President Biden has to worry about. There's also geopolitics. And we had the president of Indonesia, Joko Widodo, speaking with Bloomberg's editor-in-chief, John Micklethwaite, overnight, saying that Vladimir Putin and Xi Jinping are going to show up to the G20 in Bali in November. If Vladimir Putin goes, realistically, do we think that changes President Biden's plans to attend?
It's a fair question. I don't know if they're going to back out, but it's difficult to imagine the scenario entirely of President Biden, Xi, Putin, and keep in mind, Vladimir Zelensky was also invited and was supposed to be in Bali as well. It seems unlikely that the four of them would all be there at the same time. Regardless of exactly how the White House decides to respond to this, it very clearly is a failure from their perspective. They were trying to push for Putin not to be invited. They pushed for Russia to be kicked out of the G20. So clearly they have to figure out how they respond to something that is absolutely a disappointment to the White House.
Well, and of course, Xi Jinping and President Biden have issues of their own right now, specifically as it relates to Taiwan. Jack, do we have a firmer sense of whether or not U.S. policy really has shifted in the last several weeks as we see more activity in the Taiwan Strait?
The U.S. policy may shift, but right now the White House seems to be playing a bit of a game of wait and see. Not only was there the Chinese reaction to Speaker Pelosi's trip, but then there was another congressional delegation that visited Taiwan, and the military patrols happened again around Taiwan. The White House has tried to not overreact to that, but it makes it more difficult for them to make a decision on lifting tariffs or any number of other policy items that would be difficult to figure out regarding China. It may lead them to find common ground, just find somewhere on climate, for example, where they can work together with China. But it's a bit difficult for the White House to figure out exactly how their policies on China would change now, because there's so many moving parts the last 2 weeks or so.
Hey, Jack, thank you. Down in D.C., Jack Fitzpatrick there of Bloomberg Government. TK, I'm pleased you brought up the Secretary Yellen point. Just an unbelievably talented economist who at times has been invisible in this administration, and right now is one of those times.
This happens. I think it's my basic take, John, is it's always in every case the comfort of the president, and all we can suggest is President Biden is not comfortable. I'm baffled by it.
There have been reports, Tom, that she's frozen out of meetings and hasn't taken a central role.
You know, I'm clearly biased here. I loved it. What I love about Janet Yellen, John, is when she gets angry, her accent switches to Central Brooklyn. It's hilarious. Her accent just changes to her childhood.
I have to say, I haven't heard her get angry too many times, Tom.
Yeah, I would make clear that the word that she owns is the word slack. She is the one that had a primal scream. There's a slack in the American labor economy.
How much slack is there now? Here come the cuts. Kelly Lyons, Wayfair.
Yeah, 5% reduction of the global workforce affects about 870 employees. Did you see the survey out of PwC yesterday, John? They interviewed 700 executives. Half of them said they are planning to reduce headcount if they haven't already. Talk about a slowdown in the labor market.
Brutal survey, wasn't it? Pretty brutal. Futures right now, down 0.9%.
I was watching Dr. Oz's video.
I'll update you on that survey a little bit more in a moment, Tom. On the NASDAQ, we're down 1 full percentage point. Yields are higher, stocks are lower. From New York City, heard on radio, seen on TV. This is Bloomberg Surveillance.
New York City this morning, good morning to you. Here's your price action. We're negative 1% on the S&P. We fade on the NASDAQ. We're down 1.04%. And Michael Hartnett over at Bank of America coming out with all the stats this morning. Just four names, Microsoft, Apple, Amazon and Tesla. Those four making up 30% of the move we've had off the lows, all 17.4% of it, Tom, over the last few months, from June 16th to the peak. Not so long ago.
John, let's help with this. 7.4% Apple, 6.0% Microsoft, Amazon 3.5%, Tesla 2.1%, 13, 5, 18, make it 19% of the index, John, of those four stocks.
We've seen some big moves from those four stocks as well. The other thing that Michael Hartnett pointed out as well, Tom, is just the size of the move. And he looked back at the last 43 rallies of more than 10% since 1929. And he identified the fact that they average about 17.2%. So that's your average bear market rally of more than 10%. This 17.4% one, Tom, he's basically saying is a textbook bear market rally. I can tell you we're fading right now, TK.
Well, we're fading right now, and we're doing it being led by foreign exchange. The DXY is a strong dollar. Moments ago, printing through 108. That's a big deal, John.
Going to get to the FX market in just a moment. I want to start with the bond market first, though. Look at 2s, 10s and 30s. Talked about where we closed out last week at 324 on a 2-year. Just north of that now at 326. Call it 327. We're off the highs of the week as well. We got to as high as 337, then faded after the Fed minutes. We're building some weight back into the front end of the curve again. again, up 7 basis points on 2s, up 6 or 7 basis points on 10s. So yields are higher, stocks are lower, and the dollar is stronger. You can see that against cable, you can see that against euro dollar. Let's take a look at the euro. Jordan Rochester of Nomura pointing out this morning that we are not priced well for a recession at all. He's looking for a move down to 97 on euro dollar. Right now, Tom, 10054. Just about holding on to parity.
And this is the, you know, Keynes. When the facts change, I change. You wonder how these central bankers are going to adapt and adjust to the dollar and the multiple currency dynamics. I mean, they're tangible, and they will be in the back of the mind at Jackson Hole.
Well, Tom, they'll be in the back of the mind of that ECB meeting as well, because that weakness through the FX channel is going to exacerbate the problems they have with imported inflation.
Yeah.
They need to get a grip of that. Let's get a grip on that. They're set to go 50 basis points again. But, Tom, that's a 50 basis point hike into real potential economic weakness.
I'm going to sell it again. I think we need Madame Lagarde at the Jackson Hole meeting.
Have you emailed her?
Yes.
Did she respond?
No, but her people did.
And what did they say? Is she going?
Said, no.
No. OK.
No.
Well, I'm pleased we cleared that up, Tom. That's a cross-asset price action. Let's get you some movers this morning. We can do that with Kelly Lyons. Hey, Kaylee.
Hey, John. Well, I have to begin with Bed Bath & Beyond because it is an absolute plunge this morning in pre-market trading. And really, one man is to blame. That would be Ryan Cohn, the founder of Chewy.com, who is now no longer a shareholder in Bed Bath & Beyond because he sold his entire stake. And really, the fact that he was a shareholder is in part what drove the rally in the shares that we had seen. Remember, this stock was up 400% from late July through Wednesday, then down 20% on the news he might sell. Then he did it, and the stock is down 43% as a result. And you're seeing really air coming out of the entire meme stock trade. GameStop down about 10%. AMC is down 6% as well. That's one highly speculative area of the markets. Of course, another one is crypto. And given the risk-off sentiment we are seeing today, Bitcoin is sinking as well, down about 8%. And that's weighing directly on crypto-related equities like Coinbase, the big crypto exchange, down about 9%. There are a few earnings stories still out there, even though basically today will be the wrap-up of earnings season after Deere reported this morning, lowering its profit outlook for the year due to inflation and supply chain issues. That stock down 5.4% as a result, and even Applied Materials cannot get a gain here, even though its revenue guidance was better than expected. It, of course, is a manufacturer of the equipment that makes semiconductors, and even though that outlook is softening, they're still feeling bullish on the outlook for their revenue picture, but that's not enough to do it for the stock on such a down day, Tom. It's essentially flat before the bell.
Interesting to see, and we'll have to watch this with the VIX now down a full stick, 1.24 points, 20.80, excuse me, a higher VIX, showing the angst that's out there. Evan Brown with us now as we calibrate into September, head of multi-asset strategy at UBS Asset Management. I need to know if it's a time to sit tight, Evan, or is it time to be supple and at the margins move an asset mix around?
Yeah, hi Tom. I think it's a time to be supple. There's so much macro uncertainty right now. You've got stagflation in Europe and the UK. You've got disinflation in the US, but we don't know where it's going to land. A lot of moving parts with central banks, and so it's not really the time to be taking big absolute directional bets. More of a relative value environment.
Where does that leave the bond market, Evan? Not just equities.
So I think with bonds, it's yields can drift higher, but it's more about the flattener, right? We have this situation where growth is slowing, but the Fed is tightening. Two different moving parts that should put upward pressure on front end yields. But looking further out, you've got kind of an anchor on long term yields because of what's happening in Europe, but particularly in China, right? We're really not seeing the stimulus that we expected to really take hold. And these small interest rate cuts are not going to be enough to really boost domestic demand. So that's going to put a lid on how much U.S. yields and global yields further out the curve can grow.
Evan, with that in mind, where does that leave the dollar?
More dollar upside. I mean, you've got this a Fed that's going to have to continue to raise rates, or at the very least keep sending the message and send the message even more that these cuts that are priced in 2023 need to come out. And the easing of financial conditions that we've seen, means the Fed is going to have to keep pushing back more. And then in the meantime, you've got slowing China that's weighing on global growth. So U.S. growth doing okay, U.S. tightening, ex-U.S. growth struggling. And in Europe, stagflation, where it's very difficult to get real interest rates higher. And so real interest rate differentials still move in favor of the U.S. and the dollar goes higher.
Well, to that exact point, Evan, the headline crossed the terminal just a few minutes ago that the yuan is at the weakest level since 2020 on that widening rate differential. As we talk about the growth struggles in China, the idea of slower growth coming from the world's second largest economy, stagflation in Europe, which is frankly just in crisis, how much of that has a bearing on the Federal Reserve? John made the point yesterday that Chairman Powell might not even want to bring up the rest of the world because that runs the risk of being perceived as perhaps more dovish, given how brutal the picture is elsewhere.
No, I think that's a really good point. I mean, the weakness in the rest of the world, but particularly the strength of the dollar that's come from that, is putting downward pressure on core goods prices. And we especially saw that in the last inflation print. That is helpful for the Fed in achieving its price stability goals. But the focus is going to be shifting a lot more away from the core goods inflation coming off, the pandemic-related temporary effects coming off, but then still stubborn services inflation. So, Powell can acknowledge that improvement in core goods coming from what's happening in the rest of the world, but he can't lose sight of or de-emphasize what's still really tight labor markets, still rising wage growth, still rising shelter inflation, services inflation. So it's, navigating that is a tricky message.
Yeah, and as we talk about kind of the dollar and the strength that we're seeing, I wonder if there's another way to hedge, because I'm looking at the markets this morning and you don't want to buy bonds, you don't want to buy stocks, you don't want to buy commodities. The only thing anyone looks like they want to buy is the dollar. Is there another way to play defense in this kind of market, Evan?
Yeah, I mean, I think the main way to play defense is through the dollar, but also in less cyclical equities. So you can talk about healthcare, you can talk about factor-wise minimum volatility, which is kind of a risk-off sector, but not as expensive as staples and utilities are. So I think those are interesting ways to have a little bit of defensiveness within equities outside of FX.
Evan, just awesome to get your views this morning. Thanks for being with us, sir. Evan Brown there of UBS Asset Management. It's a difficult morning brewing right now. We've got futures down about 1% on the S&P. On the Nasdaq, we're down about 1.16%. We had a couple of mornings earlier this week where we had negative moves in the morning and then they faded into the close. We'll see if these stick, but yields are higher. Yields are higher and stocks are lower, Tom. We're up 6 basis points on a 10-year.
Is the gloom now any different than the rationalization of gloom, say, June 10th or June 12th?
I think, Tom, the gloom has changed in the sense that the data's been okay, that it's held up. I think the gloom has just been pushed out. The same debate exists around the Federal Reserve. One, how far do they have to go? And two, how long do they stay there?
How long is everything to me?
How long do they stay there? And that's the big debate around 2023. We keep playing that clip from Kelsey Barrow of JP Morgan. I think Kelsey's right on the money. That's the big split right now. The Fed that's saying we go and then we hold, and the market is saying you'll go only so far and then you'll start cutting, and they're pushing back against that.
For our viewers and listeners who have invested in the stock market for retirement, and for, serious issues, John, why is this chit-chat any different than June 10th of this early summer? And I don't think it is.
I'm not sure it's changed, Tom, except the price of the story. The price of the story's changed.
Yes.
We've had a 17% move off the lows.
Well, I would also argue that the thing that has changed is earnings season happened, and it really wasn't as awful as anyone was expected. I wonder to what extent this rally is actually predicated on better fundamentals versus just hopium about the Federal Reserve, because both were happening at the same time.
And then payrolls blew up the story.
And that.
Payrolls blew up the story in a massive way. I think year-over-year peak inflation was to be expected. I think the real one that's added some real spice to the division right now over the outlook is just payrolls holding up the way they have done. When you started to see claims climb, Tom, and this whole theory started to kick in, which was now we see it, the weakness in the labour market, and then you don't, just like that.
And we're going to get claims sitting on the lawn at Jackson Hole Lodge next week. And, what if they go better? There's a lower statistic. I mean, I got so much Vujade back to.
Vujade.
The only difference. The only difference now, John, is back then the Yankees were winning, and now the Yankees are not winning. That's the distinction.
Are they still leading that division, Tom?
I don't really follow the Yankees. What I can tell you, the common feature, the Red Sox were losing back then, and they're losing now. Thank you.
Futures down 1% on the S&P with Tom Keene and Kelly Lyons. I'm Jonathan Ferro. Lisa back on Monday, counting you down to Jackson Hole, Wyoming. Seth Carpenter and Morgan Stanley joining us very shortly. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A judge says that part of the FBI affidavit used to get a search warrant for Donald Trump's estate should be unsealed. The judge has given the Justice Department a week to propose what should be blacked out. News organizations and others have asked for it to be released. China has reported the worst week of COVID infections since mid-May. They've been fueled by outbreaks in vacation hotspots that risk spreading across the country. There were more than 18,000 new infections in the week that ended Thursday. Even if your company isn't planning layoffs, the one next door is. That's according to a study by consulting firm PwC. It polled more than 700 U.S. executives and board members and found that half said they are reducing headcount or plan to. 52% have implemented hiring freezes. The largest maker of farm machinery, Deere, has cut its outlook for the full year. The company warned of supply chain issues and higher production costs. Deere says it has been able to offset some of its problems with price increases. California-based fund manager PIMCO is using its deep pockets to buy assets that have been hurt by the cost of living crisis. The firm has spent more than $2 billion to buy leveraged debt backing consumer companies that banks struggle to offload. Bloomberg's learned it's part of PIMCO's broader strategy to capitalize on depressed prices. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Has been getting some relief from the fact that inflation's been a little bit better. Sentiment was very bearish. We've had some better than expected economic data, but I don't think these issues have been resolved, and we still think that the Fed has more to go, and then also will ease policy less next year as they want to stay serious about inflation.
It was awesome to catch up with Andrew Sheets and Morgan Stanley just yesterday. We need to catch up with this market right now with Tom Keene and Kelly Lyons. I'm Jonathan Ferro. Breaking down on the equity market, down 0.9% on the S&P. On the Nasdaq 100, down 1 full percentage point. The price action, though, to be fair, is elsewhere. Yields higher by 6 basis points on a 10-year stateside, 293.90. Elsewhere, gilt yields higher, bund yields higher. BTP's Italian bond yields much higher by 18 or 19 basis points over in Italy to, let's call it, 350 now. And off the back of some of this, the dollar just eating up G10, ripping through it. Cable, Tom. Sterling down by 0.9%. That's a weaker pound. Cable down to 118.20 this morning. Euro dollar just about holding on to parity.
The hallmark, folks, of surveillance is to use our language carefully. I'm not going to say sterling plunge, sterling in free fall, but John, it does have elements of that as we approach the 117 level. John, it also the North American complex with Loonie out to 130 and peso, which has been strong peso recently, 20.25 gets my attention.
Yeah, I've got the dollar stronger against basically everything in G10, Tom. I'd say maybe with the exception of the Swissy. The Swissy against the dollar basically unchanged on the morning, but then maybe that speaks to the defensiveness you're seeing elsewhere too.
We won't frame it right now, but we are watching Euro Swissy, and we'll continue to do that for you this morning. Futures -39. Julian Lee is definitive on oil. He writes for Bloomberg Opinion. He's, to say, an oil strategist that barely describes his academic acuity in the market. Julian, an open question on a crazy Friday. In supply and demand, what is the distinction you would write about next week?
I think next week it's going to be about two things. It's going to be about the will they, won't they revive the Iran nuclear deal. And it's going to be very much about outlooks for demand and outlooks for the broader economy. I mean, I think, this side of the Atlantic, we're in real difficulties.
So a huge question, Julian, for me, is it doable to measure demand, or is it entirely after the fact where you have to wait for the time to go on to really see what the demand did? Can you get out front on demand analysis?
I don't think you can get out front really on measuring demand. Even if you look at trying to measure demand historically, that is notoriously difficult. I mean, you see revisions to demand 5 years and more into the past. So it's always on demand, much more of an estimation game. And so people will be looking at, all sorts of outlooks of other things to get a read on demand.
What about, we've focused so much on demand in recent weeks, Julian, given the narrative out there about growth slowing. Are we overlooking how constrained supply still is?
I think there's certainly in some circles a concern that we are doing just that. I mean, Bloomberg TV had this interview earlier this week with the new Secretary General of OPEC, who said basically we have no spare capacity or almost none. We've got European Union sanctions on Russian crude due to come into effect in December. We've had a rebound in the last month or so in Libyan output, but that remains fragile. That could be gone again in almost the blink of an eye. We're still in what has so far been a mercifully quiet hurricane season in the Gulf of Mexico, but that's still not over. I was on the coast of Florida, close to the Louisiana border last summer, and I ran away from a hurricane then. So I caught the edge of one. A big hurricane could tear through and do some real damage to production. There is a lot of fragility on the production side.
Julian, I want to wrap things up with the reality check that we could get on the European front come September, after all these summer vacations are complete, and hopefully the likes of Spain, Italy, Portugal, Greece can get as much money in as they can. Because, Julian, the talk that I'm hearing is that we are going to go to some serious effort to reduce consumption. Julian, the ideas that are being thrown around at the moment, what do you think we need to pay attention to?
Well, I think many of these ideas are around natural gas rather than oil. And electricity too. And one of the things that we're seeing is more oil being used to generate electricity and industrial heat where you can. So saving everything is important. I think we are going to see people turning the lights off in office buildings, people turning the lights off on iconic buildings that are floodlit. We still don't seem to be seeing a great deal done to retrofit insulation in homes, certainly not in the UK, and I don't think in many other places. That obviously is a longer term solution, but it's an important one. And I think we need to start getting serious ahead of this winter about saving energy, about using energy much more efficiently.
4-day work week, Julian, is that what we're heading towards?
I don't see that yet. Working from home more, perhaps, that's a real possibility. I think the pandemic has shown that for many people that is a realistic possibility, and we may well see people asked to do that again.
Unreal.
For a very different reason.
Unreal. Julian, thank you. Julian Lee there with the latest out of London. TK, the prospect of some real effort to curtail energy consumption in Europe later this year.
We're making jokes about the foliage, John. Nothing about this is going to be funny.
Oh, absolutely not.
I mean, this
no
is
way.
like... the only thing I can come up with, John, is what Folkets Landau said the morning of the invasion, this war in Ukraine. And David Folkets Landau said, you're going to see a fiscal impulse from Europe that no one living understands. That's where we're heading.
Well, as Julian just said there, Kaylee, the pandemic playbook is there in a certain way. This is just a very, very different issue.
It's very different, and yes, we know that demand can be reined in by working from home and people not commuting. But again, the seismic shift in supply and the ability to access energy to power economies working from home can't solve it all. Demand reduction that the European Union needs to do in order to get consumption down to levels that can actually be matched with the supply and the inventories available, that's going to be a really, really hard effort, John.
And monetary policy and fiscal policy will look very, very different to what it looked like back in spring 2020. If you're just tuning in, we are lower. We're down 0.9% on the S&P, guiding you towards the weekend. It looks like we're about to close the week with a week of losses. We were coming into Friday positive by about 0.1%. Futures eating into that. We're down by 0.9% on the S&P. On the NASDAQ 100, we're down by, let's call it 1 full percentage point, TK.
John, I want to walk through this. It's important, as we've heard people say, 4 stocks move the market. The SPX and the Dow, I don't believe, have ever been wider, where the Standard & Poor's 500 has 4 stocks with a market cap of 19%, and the 4 of the 30 Dow stocks, John, make up 29.4% of the index. That is ridiculous.
And one is a ridiculous price-weighted
But we still
index.
quote it, John, because it's a fabric of America.
No.
The markets are focused on the idea that the economy is softer and that the Fed is not quite done yet.
As we've seen stocks bounce back and as we've seen some of the most speculative areas of the market bounce back, that's going against one of the things the Fed is trying to accomplish.
Right now, I just don't see how the Fed is going to be able to actually bring inflation back down to 2%.
The Fed never stops hiking rates when the real Fed funds rate is still negative.
Central banks, all powerful institutions, but they're clumsy institutions.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Kaylee Lyons in for Lisa Abramowicz. Don't ask the CDC if the pandemic's over. Ask Mary Barra and General Motors. John, it is a wonderful symbol of how this nation moves forward.
Yeah, but they've lagged Ford, Tom, and Ford did this at the end of 2021. It's taken some time for them to catch up. They halted that payout back in spring of 2020, and it's back. GM to reinstate the quarterly dividend at 9 cents a share, resuming the share buyback as well. A 2-year hiatus, TK. It's back, and if you want to go there, it's the end of the pandemic, I guess, on that front.
The opportunistic word for me is opportunistic. There it is. Plan to resume opportunistic share repurchases. John Daniel Ives yesterday told us he thinks the tax on share buybacks really doesn't matter. It's noise. And there's Mary Barr doing a tech equivalent.
Yeah, a tech equivalent maybe at a much, much smaller size, Tom, because the tech firms are doing it at a much, much bigger level. They've rallied and rallied hard off the lows. And now, Tom, we start to fade. We're down by about 0.8% on the S&P this morning. On the NASDAQ, down 1 full percentage point. GM, positive 3%. Call it 2.5 in the pre-market.
Celebrate. Let's do it. I mean, come on. It's a constructive sign here. Now, we do it, John, within a market that's challenging. John, can we jump to FX to begin with? Not the data check, but let's just talk about the import on a summer Friday. This is not dull. These are markets on the foreign exchange move.
And this is super defensive, and we're seeing the dollar rip into G10 this morning. We've seen that many times throughout this year. It's happening again this morning. Sterling down by about 0.8%. That's sterling weakness. Euro dollar negative about 1/3%. But the data, what Europe has to go through later this year, Tom,
right,
what we're all bracing for, is not pretty at all.
Kaylee Lyons all in. I looked at the JP Morgan Emerging Market Index, and EM enjoys strong dollar as well.
Or it's getting brutalized by it. Every single Asian currency, for example, weaker against the dollar on the day. You just take a look at the South Korean won. It hit a 13-year low relative to the U.S. dollar. And a lot of that has to do not just with the haven demand for the dollar, but also the weakness potentially coming from China. And the Chinese yuan, I should mention, offshore, weakest level since September 2020.
Within the stock gloom and the stock reset, we're going to get to Patrick Armstrong in a moment. So, John, let's jump into it. John, I'm going to suggest right now, John, off the beaten path, BitDog with its first bad day in ages, 23,000 down to a 21,000 handle. Maybe that's a signal to what this trading day looks like.
In line with what's happening with risk more broadly, Tom. Over in Italy and the UK and Germany, yields are higher. Much, much higher. And equities are struggling this morning on the S&P and on the NASDAQ. TK, it's all about next week now. It's on to Chairman Powell next Friday in Jackson Hole, Wyoming.
I wonder if we're certain on that. Yes, I do agree.
Confirmed,
it is about
Tom.
Jackson Hole, and I get all that. But maybe there's some other noise out there as well. And John, I agree with you. It is about Europe. And I noticed that Netherlands nat gas even legged out to new appalling strength.
How does Chairman Powell navigate those issues?
Well, this is the heart of the matter.
all week.
John,
How did they do that?
Over a beverage of my choice last night, this came up. He's giving a speech as central banker to the world.
Is he, Tom?
Yes.
Because if he
doesn't have
that's
a choice.
Very dovish speech right now, given what's happening in China and what's happening in Europe.
He's not going to throw Lagarde and Bailey under the bus, given the war in Ukraine. I would suggest it'll be an elegiac speech about the pressures that they face. Right now, an important interview with Patrick Armstrong, CIO of Plurimi Wealth. Patrick, I want to cut to the chase. The level of gloom now approximates the level of gloom of early June. Can you be long equities?
I'm net long equities where I have completely flexible mandates. We've got one fund where I can be short or long, and we're 20% long net. So I've got actually 50% of my portfolio on long equities, and I've got 30% in shorts. And there's some extremely cheap stocks out there that I've not seen in decades, really. Like a company like Moeller Maersk is trading at less than 2 times earnings today. It's paying me a 12% dividend yield. It's buying back shares. It's probably going to pay a special dividend that it'll announce later this year. So it's got a lot of cyclical risk. Freight rates are going to collapse. Market says they're going to collapse starting today. I think those rates don't collapse until we're into next year. I think supply chains remain challenged, a lot of bottlenecks. There's an amount of goods in the world that need to be shipped. And there's not enough shipping capacity. Oil and gas stocks, exact same scenario, and maybe not to the same extent. Markets pricing in oil plummeting in the future. I don't know if it will. You've not seen the demand destroyed yet. Supply's not coming on stream, and these companies are just producing massive cash flow every day.
Patrick, it sounds like you're still long inflation.
Well, I think inflation's plateaued in the United States, and the strong dollar, lower commodity prices are going to see year-on-year prints continue to go down. In Europe, in the UK, commodity prices haven't fallen in the same way because the currencies have fallen and electricity prices are jumping and European natural gas is moving higher. So I think you've got a lot of stagflationary forces that are remaining in Europe, where the US is probably past the worst of that.
Patrick, just how bad is the story in Europe? And how bad is it relative to the price of the story in the market?
I don't think the market's really priced in how bad it can be in Europe, unless something dramatic changes where you do get Russian gas into Europe again. Manufacturing is going to slow, hiring is going to slow, there's going to be brownouts and blackouts, people told to work from home. All of those things are negative for the economy, obviously. And it's just Germany's going to solve its reliance on Russian natural gas, but it's just not going to be in 2022 in the winter of 2023. It's going to be another year and a half before they can get all the other measures in place that they're not reliant on Russian natural gas.
On the subject of Europe, Patrick, one of the lines in your note that stood out to me was the market has the ECB hiking while the Fed cuts in 2023, ... No way. What do you think is more likely, that neither is hiking next year or that both still are?
I think neither will be hiking probably when we get to 2023. The U.S. economy is slowing. It's still growing. The employment situation still looks pretty robust. That 49% of small companies say they're having trouble filling job openings. So there's anecdotal evidence about layoffs coming. The PwC survey is talking about half of companies doing layoffs next year. But companies aren't being able to fill the job openings they have. Fed's going to be hiking in September. Maybe once more after that. But while the economy slows and the rest of Europe falls into a deep recession, I don't think the Fed's going to be doing much in terms of hikes next year, but there's no way the ECB will be hiking with that backdrop.
Well, I understand how the data could lead to a picture of the Federal Reserve backing off, but does that leave the job on inflation undone?
Yeah, so Powell characterized where rates were after the last hike as neutral. I don't think that could have been scripted. I don't think it's at neutral. I think if we do another 75 basis points, you can plausibly say that's at neutral. If the economic situation does weaken in the rest of the world, you've got a really strong dollar, that continues to mute out inflation as well. So strong dollar means all your imports are a little bit cheaper, and that is disinflationary. So you can see that scenario where the Fed doesn't have to hike next year just because the dollar is strengthening and the rest of Europe is probably in a pretty bad economic situation.
Patrick, how useful is this conversation around neutral? Neutral is such a fuzzy concept, and they're talking about a short-run neutral level, a longer-run neutral level. How useful, how valuable is that conversation right now?
Well, if you get any insight onto what the Fed thinks is neutral, that's very important because that's the guy that'll guide you on where they're going to put policy. I don't think Powell believes it's at neutral right now. you've seen a lot of liquidity in markets. You've seen meme stocks rallying. You've seen no earnings tech rallying, and you've not seen the Fed meaningfully reduce its balance sheet, which is the other thing they indicated they would be doing, which hasn't really happened yet. But where neutral is something no one will ever know. Even looking historically, you never know exactly where it is. But it does guide the Fed in what they're trying to achieve while they're, I guess, driving half blindfolded.
Patrick, good to catch up, sir. As always, Patrick Armstrong there of Plurimi Wealth. Patrick mentioned that PwC survey. We've mentioned it a few times through the last few hours, so let's go through it. They basically surveyed, Tom, 700 US executives and board members across a range of industries, and this is the breakdown. Half of respondents said they're reducing headcount or plan to. 52% have implemented hiring freezes. More than 4 in 10 are rescinding job offers, and a similar amount are reducing or eliminating the sign-on bonuses that have become common to attract talent in the tight job market we've been talking about for the last couple of years, Tom. So there's some of the numbers.
There's selected industries that are still booming, but they're selected. And it shows a disparity in America, and frankly, comes right over to the political ballet. John, you didn't ask me about the neutral level.
Tom, what about the neutral level?
I believe in Newtonian 19th century economics.
You need to translate that.
I believe in what's called plug and chug economics, and the plug and chug of a neutral equation is a comedy. There's just too many moving parts in the ballet of what is neutral policy.
Well, you saw the pushback, Tom, from Larry Summers and Mohamed El-Arian off the back of those comments.
I believe you got an equation, you put in one thing, you put in two things, maybe it's some cocktail talk. You're putting in 3, 4, 5 things, you're assuming this, you're assuming that. John, it's just silly.
Have you noticed, Kaylee, that Tom's cocktail talk is very different to our cocktail
Yeah,
talk?
I wouldn't exactly call it casual cocktail talk
Well,
when it's
is that
Euclidean
casual?
geometry.
No, the theme this summer, we're doing 2 things this summer, seriously. We're reading, I talked to John Micklethwaite about this, a spectacular Claire Jackson effort on Stuart, England, John, when the Pharaohs first came over, really interesting about the English Civil War. And I'm revisiting, because of all this odd dynamic, Zemansky's thermodynamics, because there's some movement there which shows how stupid the study of the neutral rate is.
Incredibly useful stuff, Tom.
It is.
I'm looking forward to the book
This
reviews.
is what you do when the Red Sox are in last place.
You stop watching baseball and you start reading.
Can I get the cliff notes, Tom, when you're
interesting
ready?
stuff. Yeah, we'll all take a round of those notes, Kaylee. Futures down 0.9% on the S&P this morning. Good morning to you all. It's defensive out there. Yields are higher by 8 basis points, 296.47. Coming up on this FX market, $8 stronger. Jane Foley of Rabobank from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Fed officials are offering mixed signals about the next interest rate increase. Their 2-day meeting is set for September the 20th. One of the most hawkish policymakers, St. Louis Fed President James Bullard, backs a big move. He told the Wall Street Journal there should be another 75 basis point hike. Meanwhile, Kansas City's Esther George was more cautious. She said the Fed has already done a lot of tightening. China's President Xi Jinping and Russia's Vladimir Putin are planning to attend a Group of 20 summit later this year in Indonesia. That's according to Indonesia's President Joko Widodo in an interview with Bloomberg. Their presence would set up a showdown with President Biden and other leaders opposed to Russia's invasion of Ukraine. Meanwhile, European intelligence officials say Russia is probably using a nuclear power plant in southern Ukraine to shield troops and equipment. That's a tactic that undermines the security of the plant. The nuclear facility is Europe's largest. The US, UK and EU have demanded access to the plant for international inspectors. The shares of Bed Bath & Beyond are plunging. Investors reacted after news that billionaire Ryan Cohen has sold his stake in the struggling retailer. Cohen pocketed $68 million, a 56% gain in an investment he had held for 7 months. But retail investors are feeling the pain. Their net purchases of Bed Bath & Beyond surged the last 3 weeks. And Foot Locker is surging today. The athletic wear retailer says CEO Richard Johnson will retire. He'll be replaced by former Ulta Beauty head Mary Dillon, who also once ran global marketing for McDonald's. Foot Locker posted quarterly earnings that beat expectations. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
think they're going to continue to raise rates. I don't think they're going to take any pause anytime soon. I'm sure they're not going to get it exactly right. That's what they're trying to do. I think if they're going to make a mistake, it's going to be on tightening a little bit too much, because they really want to make sure that they bring inflation down.
Randy Krosner there, the former Federal Reserve Governor from New York City. Good morning. This morning with Tom Keene, I'm Jonathan Ferro, together with Candy Lyons. Bramo back with us next week. Here's the price action. We're down, we're lower by 0.9% on the S&P 500, on the NASDAQ by 1 full percentage point. Look at yields, higher by 8 basis points, much higher over in Europe on bonds, Italian BTPs, on gilts in the UK. And look at foreign exchange. Euro-dollar hanging on to parity, and sterling breaking down for a third straight session, a weaker pound sterling. Here we go on that currency pair against the dollar. Cable 118.37 TK, a negative 0.8%.
Our interview of the day, Jane Foley joins us now from Rabobank. Jane, let's get right to it. John's got a lot of technical questions. I've got one that's just simple. There's a log vector of weaker sterling, and then it rolls over. At what level is the tipping point you have in your head where things fall apart for Governor Bailey?
Well, to be honest, there's an awful lot of pressure on Governor Bailey already, certainly from Liz Truss, who looks as if she could be the next Prime Minister of the UK. But I think we could be heading down to 115, maybe 114 on cable, and that would add an awful lot of pressure.
I don't mean to interrupt, but if we go to 114, is that a trend and a controlled trend, or do things, to borrow a phrase from politics, unravel?
You know, I think if we're at 115, 114, a lot of that actually really does depend on the dollar, and specifically on euro-dollar, because what we're seeing at the moment is if euro-dollar dips, and of course it's been dipping, it's very difficult for cable to hang on in there. It's been dragged lower too. So a lot of this is a dollar move, certainly over the last week. But that said, there is a lot of sterling weakness. You know, the pound has really been suffering, I would say, for the last 4 or 5 years. Since the 2016 Brexit referendum, sterling has never really been able to recover. Investment has never really been able to recover. Investors are still quite skeptical, I think, of the post-Brexit UK economy, and the government that we've had hasn't really been able to convince investors to come back in. You've got to bear in mind that the UK's got a current account deficit, and if those overseas savers are looking in at the UK and they're not liking what they're seeing, well, you know, sterling is likely to adjust low, and I think that's the situation that the pound finds itself in. And without the growth, without the investment, I think sterling could remain, you know, pretty weak for a while.
Jane, do rate hikes make a difference? Are you saying they don't?
I don't think they do. I mean, look, if you go back to May, we had, admittedly, an as expected interest rate hike then. It was a 25 back then in May. And sterling really dove. And the reason it dived lower was because the Bank of England at that point in its quarterly review downgraded the downgraded the growth number. And if we fast forward to August, the next quarterly review, this is the one where we have the governor saying we're going to have a 5-quarter recession. And again, you know, sterling reacted badly because, you know, if we think that a lot of this is about the lack of investment growth in the UK, investors need something to hang their hats on. They want to see improvements in productivity, improvements in growth, and that's not what they're seeing right now. And that's, I think, why sterling is really so weak.
Well, and the BOE obviously is in a tough spot in that regard, but the ECB is too. There is a question of whether they can do anything to support the euro. If we get a break of parity once again, where's the bottom?
Well, you know, I think if we were to break parity, I think there's every reason that we could fall quite fast, maybe towards 95. I think there's some options below there which could trigger such a move. And I think you're right, really, to make some comparisons between the Bank of England and where the ECB could find itself perhaps in a few months' time. Because if we look at the situation in the Eurozone, it's all about energy. We know that. If we do have, say, blackouts in Germany's industry groups over the winter months, if we do have the market, you know, panicking about what that would mean for growth or lack of growth in the Eurozone, but that wouldn't necessarily do anything to bring inflation down. So we could have a hawkish ECB in that sort of scenario, but that wouldn't be a scenario which would be beneficial for the euro. So again, it could be that the growth worry overtakes the outlook for the currency over and above the hawkishness of the central bank.
Well, and there's a question of causation here. Is it weakness of the euro or strength of the dollar more so? And on that point, where do you think the peak is on the DXY?
Well, you know, I think we're going to remain strong at least for the next 6 months. And I think you're right. For instance, if we look at the G10 currency performance today, actually the euro is holding in relatively well, actually better than many of the other G10 peers. So this is about dollar strength right now. I mean, of course, there's euro weakness in there, and the energy story is really important. But this is about dollar strength. And to be honest, I think for a while the dollar's got these two-pronged factors driving it, and the first is of course the Fed, and now the market's again thinking that the Fed could be higher for longer in terms of interest rates, that maybe it needs to keep interest rates higher next year in order to really get that inflation back in the box. But the other factor is of course safe haven, and don't forget at the start of the week we had a lot of poor Chinese data. Now that's really bad for emerging markets. It's really bad for world growth, and that is, you know, part of the attraction of the dollar, this safe haven flow. So I think both of those things together have been pushing the dollar higher, and I don't think the dollar's done yet.
Jane, with that in mind, what's the downside on a currency pair like cable? Now, once you take out the mid-July lows, what next?
You know, I do think 115, 114, you know, we could certainly see there. But it does depend on where euro-dollar goes, because there's a bit more of an equal battle at the moment between the poor fundamentals in the sterling and the poor fundamentals in the euro. So I think the guide here will be euro-dollar.
John, off her wonderful comments, Jane, you'll love this. I just did a log interpolation of euro-sterling over to sterling dollar. You ready, John? 111.
111.
If you get sterling to strengthen against euro, as Ms. Foley talked about, it roughly interpolates to a 111.
Jane Foley of Rabobank.
Wow.
Jane, awesome to catch up. Some big numbers in the mix right now. If you're just tuning in, equities are softer. We've seen moves like this a few times through this year. We're down about 1% on the S&P. We've seen it many times on the NASDAQ. We're down about 1.12%. But there's some real dollar strength out there. Euro-dollar clinging on to parity. Euro-dollar 100.51. And sterling, Tom, clinging on to 118 against the US dollar, 118.28.
Yeah. And it makes it all the more interesting, you know, 117, 116, and the degrees of freedom that they have. John, where are we on the election, John? Thank God it's shorter than the U.S., but is it like a big weekend for Truss and
wrapped
Sunak?
up, Tom. We'll have this wrapped up by the end of this month into September.
That's brilliant.
Once you get into September, we'll have it all ready to go for you.
Okay.
Right when the leaves are changing.
Calling it a leadership contest, Tom. Maybe not an election,
We
so we
could
don't
combine,
confuse
like,
people.
you know, the crowning of the Prime Minister with a Premier League visit.
You want to go and watch Spurs?
The fall foliage.
What
in
we should do, Tom,
Scotland.
is skip school on Monday and go and watch United Liverpool. That's what we should go and do. Let's go do that. Kaylee's got the reins on Monday.
We could take in the fall foliage in Scotland.
Okay. From New York, this is Bloomberg. Live from New York City this morning, a good morning to you. Light on the data front, we're counting you down to Jackson Hole, Wyoming, and the annual Fed get-together. Chairman Powell confirmed to speak at 10 a.m. Eastern Time next Friday. From New York this morning, good morning with Tom Keene and Candy Lyons. I'm Jonathan Ferro. Defensive this morning at down 0.9% on the S&P. On the NASDAQ 100, down by 1.1. Equities south, yields heading north, up 8 basis points, 296.66 on a 10-year. Dollar stronger, euro dollar 100.53. And commodities softer. Crude lower, $89 a barrel. Tom, we're down 1.65% on the day.
Let's get right to it. And currency market's really moving right now. It'll be interesting to see what we do really in the next 1 hour to the market. Opening DXY solidly above 108. We're watching sterling, John and I, 118.31. We will speak to him the day before Powell speaks, and a data-dependent Fed will change to next Thursday. Seth Carpenter of Morgan Stanley will join us. We will be in Jackson Hole. He'll be cool, calm, and collected on the East Coast. We're thrilled that Mr. Carpenter could join us this morning. Seth Carpenter, your note is frightening. The brewing storm you talk about, it sounds like winds of war from 1939 in all. Define the brewing storm. What is the distinction now of this August of 2022?
Yeah, I mean, I think for markets, August is always a low liquidity moment, so you're going to see all sorts of choppiness there. But I think when it comes to the macro front, you've got three key economies in the world. You've got the U.S., you've got Europe, you've got China. China, we know, is struggling. They had a contraction in Q2. They've got this burgeoning housing problem that they're trying to solve. The PBOC just had to ease policy again in a bit of a surprise move. Now, we think Beijing, through various sorts of policy, both monetary and fiscal, will come to the rescue. But the question is, when does the inflection point happen? And do we get a big rebound, or is it soft? Shifting to Europe, right? You've got this restriction in gas flow from Russia's invasion of Ukraine. That's crippling the European economy. We have a baseline view of a recession in Europe, Q4 being outright contraction, Q1 being another contraction. So that's not a great look. So the US, right now, pretty solid. We got the retail sales report in line with our expectations, beat consensus a little bit. Non-farm payrolls was super strong at over 500,000. But is good news in this case? I don't know. The Fed has been very clear. They need to slow the economy down. So the stronger it is now, the more hiking they have.
You know, we always look at our guests and we try to figure out from the back of their bookshelf, Seth Carpenter, what they're actually thinking. And it's good to see that you've got Tony Crescenzi of PIMCO's Steigum's Fixed Income Bible over your right shoulder. What does the bond market tell an economist like you?
I mean, I think right now the bond market is really struggling to read the tea leaves about what's happening. We saw this sense of relief in markets, I think, when we got CPI tipping over and when the market heard the Fed saying, gosh, we're taking a balanced approach. We care about both the growth in the economy and inflation. But what I think the market didn't hear enough of is the way inflation over the next 2 years is going to come down to the Fed's target is only if you get enough slowing in growth. And so as a result, you know, we think the peak rate that the market has priced is about right, but the cuts in the that the market has in place for a lot of next year, that's not really consistent with our forecast.
Well, on that point, Seth, the market thinks that the Fed is going to get to the terminal rate and then very quickly thereafter come down from it. We've been having the conversation all week as to whether or not that's really true. How long do you think they have to stay up there?
I mean, our baseline forecast is that they're there for a year. So they get to the peak rate in December, and then the first very grudging, 25 basis point easing off in terms of a cut comes a year later in December of 2023. I mean, the short answer is no one knows for sure. We think the U.S. economy has a fair amount of momentum behind it. And more importantly, as I was saying before, they really do need to slow things down a lot. They need to take job growth from 500,000 per month down to something closer to 100,000 per month, or maybe even a little bit below, in order to get that real underlying trend inflation down. So they're going to have to stay tight for a while.
How low do you think realistically inflation will get? Is 3% going to be the new 2%?
So sadly, this is where you get the egg-headed economists talking about the two different measures of inflation, CPI versus PCE. I think 3% on CPI is very, very possible. I don't think the Fed's going to be happy to just let PCE inflation, which is really what they set that 2% target for. I don't think they're going to be happy to let PCE inflation settle in at 3%. They'll be happy when it gets down to 3% if it's on a downward trend. But they're not going to declare victory if it's hanging out at 3% and not budging.
Oh, Seth, frame your and Ellen Zentner's x-axis. To me, the big mistake here is the now of how policy is going to move. Is this really a 6-quarter, 8-quarter, even 12-quarter path that we're on far longer?
Tom, that's a great way of phrasing it. I think one issue that's important for everyone to keep in mind is that monetary policy does in fact work with a lag. We know that markets are pricing in now a peak rate that's close to where we think the peak rate is, just over 3.6%. But in terms of the actual drag on the economy from that policy stance, it hasn't shown through completely yet. We've seen it in housing. That's important. We're going to see it a bit in durable goods, and we'll see it more in durable goods, but that still has to play out. So it is not what's going on right now that matters. It is, in fact, as you say, what happens over the next 2 quarters, over the next 4 quarters, and yes, ultimately over the next 6.
How will corporations and their investment react to a pernicious 4 or 5% inflation. In the United Kingdom, everyone from Liz Truss to Mr. Sunak suggest there's been a dearth of investment in the UK. Are we going to see a dearth of investment in the United States?
So I don't think we're going to see a dearth of investment, but we should, by all expectations, see a slowing in that investment spending. What you see in the macro data is typically business investment spending tends to follow the overall trajectory of the economy. And so if we're right that the slowing in housing, the slowing in durable goods spending, and with it, the slowing in jobs leads to an overall slowing in aggregate demand, then absolutely businesses should be looking around and saying, okay, there's going to be less of a need for that sort of aggressive investment spending. I don't think it drops off of a cliff. I don't think we're going to have a massive shortfall. The UK has its own idiosyncratic issues, let's say. But we should see things starting to slow down as aggregate demand slows down and businesses pay attention to that.
Seth, we all know I read a lot of Morgan Stanley research. I share a lot of it on this program.
I'm wondering,
Seth, of course, you'd say that. Seth, I'm wondering when I received that note from you that says global recession, that's the base case. How close are we to you sending that note?
Gosh, the SEC would get mad at me if I previewed forthcoming research. So I will say this, we definitely had a global recession as one of the scenarios when we put out our mid-year outlook in April, and we are very much moving closer and closer to that scenario. I mean, the gas situation in Europe matters a lot, and we have a recession in Europe as our forecast. There's clear downside risk to China from their housing situation, which is something that's gotten worse since we wrote that note. So we're moving in that direction. I think it's too soon yet, though, to call it a recession.
Well, John, what this means is Carpenter's got to publish before next Thursday.
That's true, Tom.
That's all it means.
We need it before Jackson Hole. Hey, Seth, awesome to catch up, sir. As always, Seth Carpenter there of Morgan Stanley. In the mid-year outlook from Morgan Stanley, Tom, they talked about it, the prospect of a global recession. Yeah. We're getting closer to that bear case, I think, for a lot of people. And the surprise to the downside, we're not talking about the States. Europe's been a base case problem for a number of months now. The surprise to the downside, Tom, is coming out of China.
I'm going to do a shout out to our good friend Ellen Zettner, who's giving me fly fishing lessons for Jackson Hole. And Ms. Zettner, John, was transitory. And to her great credit, she turned on a dime in the spring of, I think it was last year. I can't remember now. But it was amazing how Zettner said, no, this is not what's going to happen. Boom.
Tom, you'll never see me. At least I hope you'll never see me have a go at a strategist and economist for being wrong. I'm just interested in the process,
Absolutely.
The framework for the thinking.
This is really important.
How it's developing.
Right.
That's my frustration as well, Tom, with some of the work coming out of Marko Kolanovic over at JP Morgan. That line from him in his note yesterday just seemed to take a dig at some of his peers. You know, clearly something changed this year, the start of this year, particularly with the invasion of Ukraine by Russia. The policies in response to that, the prospect of a European recession, these weren't on the table as the base case in the way that they are now. And things change, and you have to adapt the framework and rethink what's going to happen. And that's just normal. That's the process.
There's a grace and a humility to this because people are wrong. I think Jim Cramer over at the Death Star, John, has been really good about this. It's like baseball. You're walking back to the dugout 60%, 70% of the time. I mean, people are wrong a lot.
Is it like the Red Sox? Is this year like the Red Sox, Tom?
The Red Sox are walking back to the dugout about 74% of the time.
What's going on with that team, TK? What's going on with it?
They're rebuilding. They're rebuilding.
They're rebuilding.
This is how tough the sport is. But to the point, is Man U the same way? I mean, is Man U rebuilding?
Well, it costs a lot of money to rebuild a Premier League team that's got to compete with some big spending clubs.
Yeah.
It's going to cost them a lot of money to rebuild. And, Tom, I think they've got about 10 days left to try and rebuild. Good luck to them.
Is that like when the trading
when the
season
transfer
ends?
window closes?
I did not know that. I'm learning every day.
Futures right now down 8 or 0.9% on the S&P. Defensive, Tom, on the Nasdaq we're down about 1 full percentage point.
Tots get us started.
Tots get us started.
Saturday.
Who are they playing?
I think Bournemouth. I can't. Somebody I can't pronounce.
Someone you can't pronounce. Yeah. And then the big game's Monday, right? Liverpool,
big
Manchester United.
Yeah, it's got to be the big game.
Kaylee, thank you for being with us. Or should I say thank you for tolerating us the last 3 days.
My pleasure.
And putting in the extra shift. We appreciate it.
Yeah, she's aged. What can I say?
It's brutal. It's brutal hanging out with me and even more so hanging out with you.
Yes, thank you.
And perhaps twice as much hanging out with both of us.
She's smarter than us. She's going foliage watching.
That's why
I was going to say, I learned the most about the fall leaf patterns.
That's what people tuned in for this week.
Mostly what she got was hate mail from Virginia Tech people.
Katie, sincerely, thank you.
Thank
I'll
you, John.
catch up with you around the open and bound. Looking forward to that. A stacked show coming up. Eric Knudsen of Neuberger Berman, Etsy Dweck of Flowbank, Dan Suzuki of RB Advisors. Dan Suzuki on why this tech bubble needs to pop.
Good guest.
We'll talk to him about that around the open and bound. From New York, futures down. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. A judge says that part of the FBI affidavit used to get a search warrant for Donald Trump's estate should be unsealed. The judge has given the Justice Department a week to propose what should be blacked out. News organizations and others have asked for it to be released. Even if your company isn't planning layoffs, the one next door is. That's according to a study by consulting firm PwC. It polled more than 700 U.S. executives and board members and found that half said they are reducing headcount or plan to. 52% have implemented hiring freezes. General Motors is reinstating its dividend and restoring share buybacks more than 2 years after they were suspended. Starting September the 15th, the automaker will pay a quarterly dividend of 9 cents a share. GM halted its 38-cent payout in the early days of the pandemic to conserve cash. And the largest maker of farm machinery, Deere, has cut its outlook for the full year. The company warned of supply chain issues and higher production costs. Deere says it has been able to offset some of its problem with price increases. And California-based fund manager PIMCO is using its deep pockets to buy assets that have been hurt by the cost of living crisis. The firm has spent more than $2 billion to buy leveraged debt backing consumer companies the banks struggle to offload. Bloomberg's learned it's part of PIMCO's broader strategy to capitalize on depressed prices. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The last couple of weeks as the market's become a little bit more dovish is the market has unfortunately undone a lot of the hard work that the Fed had been doing over previous months. So they need to get back in control of the situation. Powell needs to play, or at least talk, a very hawkish game.
Seema Shah, she's Chief Strategist, Principal Global Investors there with all the different opinions that we've seen this week. Kaylee Lyons and Tom Keene, Lisa Abramowicz, scheduled to be off Halls Monday. It's about 50-50 chance we'll see her. John Farrell's going off to another property. Right now, and this is perfectly timed, on a Friday in August where you need to recalibrate for September and beyond, Barry Ritholtz joins us. He's with Master in Business, a wonderful podcast, running real money at Ritholtz Wealth Management as well. Barry, I give you the greatest credit for writing about the agony I faced a few years ago, I think 1975 and 1981, which was the comedy of defining the beginning of a bull market coming out of the horror of 73, 74. You write brilliantly on the secular and the cyclical. Is secular just a long-term view of the market?
No, secular means that there are massive forces at work in society, in the economy, in the markets, in the labor pool, in the consumer spending world. And history shows us that day to day is very noisy, but the world moves in big waves. My favorite examples, post-World War II, from 1946 to the mid-60s, the build-out of suburbia, the rise of car culture, the rise of civilian aviation, the electronics industry, on and on and on. 40 million GIs returning home with a GI Bill and getting educated and getting good jobs. That doesn't last a quarter or a year. That goes for decades.
So where are we right now?
The market reflected that.
Where are we right now? Where's our GI Bill right now? Where is our Nifty 50? Where is modern capitalism as compared to those eras we lived?
So we measure the start of a bull market when when a trading range ends and markets make new highs, and the secular bull market that began in 2013, when all three indices surpassed the pre-financial crisis high, that ran until we hit an externality, which was the pandemic lockdown. And I don't believe in the 20% is a bull or bear market. That's just a made-up media number. There's no data says 20% is significant. And you have 20 fingers and toes, so therefore, base 10, we look at 20%. When I look at what took place during the pandemic, normally a 34% drop, if it's caused by market or economic factors, is usually enough to say, hey, whatever preceded is over. But this was a meteor from outer space. This was, an externality unrelated to markets or the economy. It had massive impact on that. So when I look at that as an externality, and then I look at the $5 trillion in 3 different CARES Acts under 2 presidents, that looks to me like a giant reset, and it's very hard to be bearish there. The secular impact of all that money is going to have a huge impact for years to come, to say nothing of the 3 or 4 other spending packages, including the infrastructure package, which will be in place. So we're looking as the first half of the year sell-off as the cyclical bear within a longer secular bull. And hey, what's 20, 22% between friends when you're already up, 300 or 400%, and all of the underlying foundations are positive. Now, maybe we see a change from the Fed, the rise of inflation, rates going higher, and perhaps a recession next year or later this year. So that could help slow down this secular bull market. But from my framework, it's very hard to look at this and say we're in a new bear market like 66 to 82 or 2000 to 2013.
Okay, so Barry, something tells me you're not going to give much credence to the idea or the attempts to define whether or not this is a bear market rally or not that we have seen over the last 2 months. But whatever you want to call it, it has been a rally, a surprisingly strong one that seems to be going directly against the Federal Reserve. I thought we weren't supposed to be fighting the Fed. I mean, what do you make of what the market is not hearing from Federal Reserve policymakers?
There's this tendency to anthropomorphize Mr. Market. And I think that you have to look at the markets as the probabilistic risk-reward bets that are made by the collection of investors. And I think if you want an interpretation of what the market is saying is, hey, there's a recession out there, but it's a short, shallow recession. It will slow growth down, and maybe it slows profits down, but the underlying strength within the U.S. economy is just too powerful to get too bearish at these levels. And besides, even at 2.5%, is that where you want to tie up your money in treasuries when let's assume inflation peaked and is now 5%, 6%. Oh, I'm only losing 3% a year if I buy treasuries. That's not very appealing. And it's very easy to invert the yield curve when you're starting from zero.
A really good essay there, folks. Look for that from Barry Ritholtz on secular and cyclical bear markets. Barry Ritholtz, thank you so much. Kaylee, here in the time we've got left, let's really focus here on Bitcoin. You got to frame up crypto for next Tuesday. You going to be here Tuesday?
I am.
Or are you on holiday like everybody else?
I'll be on holiday the week after, Tom. But yeah, we're going to have a conversation and focus on mining, actually, when it comes to Bitcoin mining, because a lot of what has led to the strength of cryptocurrencies in recent weeks is the idea of the Ethereum merge, which is going to move us to proof of stake, not proof of work, which is what mining is about. But clearly you're seeing that deflate today. Bitcoin is down about 8%. We're south of 22,000 once again. So it definitely speaks to the broader risk-off sentiment and defensiveness we are seeing. And you're seeing that evident not just in cryptocurrencies, but fiat currencies as well, Tom, with brilliant dollar strength today.
Let's talk about Renault currencies, which is that they threw the miners out of China, right?
Yes.
They did. Where are they mining this week?
Well, a lot of them are mining in Texas, which has been a difficult problem considering all of the climate issues that Texas has. Some of them are in the Arctic as well. There's a whole environmental energy conversation. We'll get into it on Tuesday, Tom, but I'm going to have my weekend first.
This is a valuable show, folks. I really can't say enough about this. Crypto is trying to not be a cheerleader for the industry, but to bring diverse opinions about these raging debates. I'll be mining for Bitcoin this weekend. I'll be doing it, with Vet Bill.
Excellent.
Right. Stay with us. This is Bloomberg. Good morning.
Day 4 of the Western and Southern Open. Madison Keys was the headline maker Thursday as she claimed her first career victory over a reigning world number 1 taken out Iga Swiatek in straight sets. The American was always in control, winning 10 consecutive games in the middle of the match before closing it out 6-4 after just under an hour and a half on court. Up next for Maddie, Wimbledon champ Elena Rybakina. Elsewhere, Emma Raducanu is out. Last year's winner at Flushing Meadows went down to Jessica Pegula. The New York native had just too much for the Brit. She'll be facing qualifier Caroline Garcia for a spot in the Final Four. And Taylor Fritz flew the red, white, and blue as he edged Andrei Rublev. The Californian fighting back from a set down in a 2.5-hour marathon. Top seed Daniil Medvedev awaits in the Elite Eight. I'm Erin Coscarelli.